Okay, guys. So capital gain. So generally, it's an important area, and in the Finance Act 2024, Nirmala Madam has changed quite a few things in capital gain. So it's a very, very important chapter in terms of that. So cool. So first of all, capital asset. What is a capital asset? Is the first thing that we need to understand. So once we understand what is capital asset, basically there is always a transfer of capital asset. There is a T of CA, transfer of capital asset. So what is capital asset? We need to understand. Second part is what do you mean by transfer? First is what is capital asset. Second is what do you mean by transfer. And third one, once you transfer the capital asset, there will be something called as full value of consideration. When you sell it, you will get some money. That is called full value of consideration. From that full value of consideration, I will subtract certain expenses. And finally, what you get will be capital gain. So first there is capital asset, then there is transfer. When I sell the capital asset, I will get a, what do you say, capital gain. And how will I get the capital gain? First of all, I should get some sale price. That selling price is called as, or consideration is called as full value of consideration, FVOC. From that, I will subtract expenses. After I subtract expenses, what remains will be capital gain. And that capital gain, and that capital gain will be taxed. And that capital gain will be taxed. And that tax, I'll have to discuss various, on the tax what will be, various rates will be there. And the rates have changed now in Finance Act 2024. And based on the type of capital gain, it is either short-term capital gain or long-term capital gain based on something called as POH, which is period of holding. So this is what we need to discuss. Right? So in our notes, let's open our notes as well for capital gains. So this was done. TGBP was done. There you go, income from capital gains. Forty-five one. First of all, 45(1). Any gain or profit arising from transfer of capital asset shall be taxable under the head capital gains in the year in which transfer took place. In the year in which transfer took place. So any gain or profit in the transfer of a capital asset shall be taxable under the head capital gains in the year in which the transfer took place. Always the capital gain is chargeable in the year in which you sold the asset. But there are certain exceptions to this rule which we'll see later. So 2 clause 14 defines capital asset to be what? It means property of any kind held by the SSE whether connected to business or not. Any kind means movable, immovable, tangible, intangible, everything. Held by the SSE whether connected to business or not. Means property held by the SSE whether connected to business or not, but excludes what? Excludes stock in trade. Excludes stock in trade. Which is what? PGBP or capital gain. Guys, stock in trade is always PGBP, right? It is not capital gain. So if I am selling certain jewelry and that is in stock in trade, obviously it is called PGBP. It's not capital gain. So 2 clause 14 means property of any kind held by the SSE, whether connected to business or not. Any kind of movable or immovable, tangible or intangible, whether business connected to business or not, but excludes what? Stock in trade. PGBP is applicable. Capital gain will not come. Second, movable personal assets. So guys, capital asset means three things. One is what? Property of any kind, right? So if you see here, one is of course property of any kind. Second one, security we'll discuss. Third one is ULIP. Three things are capital asset. Three things are capital asset for which capital gain you will get. But property does not include the following. Stock in trade. PGBP, it is part of PGBP, not capital gain. Movable personal asset. Movable personal asset. Movable personal asset means what? Except jewelry, drawing, painting, sculpture, archaeological collection, or any other piece of art. So if I draw this Mickey Mouse and sell it for 10 rupees, that will be a capital asset. So guys, what is not a capital asset? Stock in trade. What is not a capital asset? Movable personal asset. This bottle is a movable personal asset. Is it a capital asset? No. This speaker, is it it's a movable personal asset. Is it capital asset? No. This mouse is a movable personal asset. Is it a capital asset? No. Jewelry is also movable, but is it a capital asset? Yes, because jewelry, drawing, painting, sculptures, all these things can add a lot of value. Because you know, paintings are sold for crores of rupees. So as I said, I draw this stupid Mickey Mouse and sell it for 10 rupees. Still taxable. Movable personal asset does not include jewelry, drawing, painting, sculpture, archaeological collection, any other piece of art. You stand in front of the mirror and say, oh, I am the piece of art. Is that taxable? Yes. Got it? Yes. So if you see movable personal asset. So what is movable personal asset? Mobile, fridge, chappal, your chappli, utensil, all your pathrays. Your pathrays, if you have a steel pathray, then it is what? Movable personal asset. What if you have silver pathray? If silver pathray also, if you have, the Supreme Court has ruled that especially from family heirloom it is coming down, no? From family heirloom. From family heirloom if it is coming, silver utensil, it is called a personal effect. It's a Supreme Court judgment. It is a personal effect. Third one, it is what called? Gold. Gold utensils, etc. If it is there, guys, 100% it is not capital, it is not exempt. It is not a personal effect. It is a capital asset. So gold, capital asset. Silver, if it is family heirloom coming from generations together, then no problem. Even though it is a capital asset, even though it is jewelry, Supreme Court said no, not needed, no problem. What about gold, diamond, platinum, ruby, silver, alloy, emerald? All these are capital assets. Even if in any shirt gold is sewn into it, gold plated sari, gold phone, all these, not gold color, actual gold, these are all capital assets. Car, BMW car, is it a capital asset? No, it is personal effect in nature. Right. So basically, that is property. So property will include movable, immovable also. Does not include. What it does not include? Stock in trade. What it does not include? Personal effect. What it does not include? Point number 3. Does not include agricultural land in rural area. Rural agricultural land is not a capital asset. Rural agricultural land is not a capital asset. Rural agricultural land is not a capital asset. So guys, what is rural agricultural land? You see here, anything where the population is less than 10,000 is a rural agricultural land. If the population is more than 10,000 but up to 1 lakh, up to a radius of 2 kilometers, this will be urban agricultural land. Beyond 2 kilometers, rural agricultural land. If the population is more than 1 lakh but up to 10 lakhs, it is more than 1 lakh up to 10 lakhs, up to 6 kilometers, within 6 kilometers radius is rural agriculture, urban agricultural land. Beyond 6 kilometers is rural agricultural land. Then population, if it is more than 10 lakh people, up to 8 kilometers radius, because it is here, anywhere here, it is urban agriculture. More than 8 kilometers, rural agricultural land. So guys, less than 10,000, it is always rural. 10,000 to 1 lakh, up to 2 kilometers, it is not rural. Beyond 2 kilometers, it is rural. Population more than 1 lakh, up to 10 lakh, cantonment area in that. Up to 6 kilometers, it is not what? Up to 6 kilometers, it is not rural. Beyond 6 kilometers, it is rural. Then more than 8 kilometers, if it is more than 10 lakh, more than 8 kilometers, it is rural agricultural land. So that one is one more thing. Apart from that, fourth item. So guys, actually what are the three capital assets? Three capital assets are property, then securities by FII, third one is ULIP. But in the first one, property of any kind, it excludes four items. It excludes four items. Item number one, stock in trade. Item number two, personal effect. Personal effect is not capital asset. Stock in trade is not capital asset. Third one, rural agricultural land is not capital asset. And fourth one, gold deposit bonds under the gold deposit scheme or gold monetization scheme is not a capital asset. This is gold is melted and it is made into bars and government takes over this gold from you and then they will give you interest. That interest also is exempt actually under 1015, right? So if you keep gold in your house, normal old jewelry, it's waste. So government is telling you you give it to me, I will melt it and give you a ISO certified pure gold bar. And because you have given me your, asset to me, I'll give you interest also. That interest is exempt for you under 1015. Good, no? So 3-4 years later, when you want to take back the gold, I'll give you that gold bar. What is the benefit for me as a country? I will take gold from all of you, which will increase my gold reserve. Now I can go and deposit it in the World Bank and get loan if need be. And gold reserve, if it's very good for the country, it is good for everybody anyway. That is the idea, right? Capital asset includes intangible assets as copyright, trademark, patent, interest in partnership, leasehold, tenancy rights, and all these things. So basically, So basically, personal effect, property of any kind does not include personal effect, does not include gold deposit bond, does not include, agricultural land, does not include stock in trade. So when you are giving the gold to the government, that is not a transfer because it's not at all a capital asset. Very simple. Right? So property also will also include any shares in the Indian company which is traded by the foreign company. This was inserted after Vodafone Idea case. Vodafone case. Vodafone Hutch and Vodafone case, not Vodafone Idea, Hutch and Vodafone case. Because when Hutch took over Vodafone, all the transactions happened outside India. But because of the transaction which happened outside India, Indian shares, Indian Hutchison SR India, those shares got transferred to Vodafone. So is that also transfer? Yes, that is also transfer. So these are the things. Apart from that, guys, two other things are actually capital asset. One is securities held by FII, then ULIP, unit linked insurance policy, for which exemption under 1010D will not apply. We'll see that later. That is also a capital asset. And when foreign investors used to come to India, they were dealing in shares, buying and selling of shares. Some people told it is capital asset. Some people told it is PGBP. If it is capital asset, long-term capital gain, that time there was no tax. So these foreign companies used to invest in shares, keep it for a longer term, sell off and pay no tax. Whereas the assessing officer told, no, you are in the business of buying and selling shares, hence it should be PGBP. So they said 40% tax. Then FII said, then I'll never come to India if you are treating this as business. So specifically for them, this was added. Any securities held by a foreign institutional investor is actually capital asset. Since it's a capital asset, you can claim long-term capital gain benefit. Deadly. So guys, this is the entire definition, meaning, etc., whatever of capital gain. Capital asset only we are talking. Capital asset is of three items. Property of any kind, securities of FII, ULIP. In property, four exclusions. Stock in trade is an excluded item. Personal effect is an external excluded item. And gold monetization scheme, rural agricultural land. But personal effect does not include jewelry, which means jewelry is a capital asset. Hope you understood, my dear friends. Yes or no? Great. It's just a marathon, so that's why we'll have to do it like this. Otherwise, based on this only, we can talk for 3 hours, which I have done in regular batch and all those things, but it's not needed. We're just doing it for the exam. As a revision, that's the reason. So we have understood here what is a transfer. Sorry, what is a capital asset? Now we have to see what is a transfer. So this is the entire thing is a capital asset. Now what do you mean by transfer? Let's see. 2 clause 47 talks about what a transfer is. First of all, sale of capital asset. We know what is capital asset. 3 items. Property of any kind. Second one, securities of FII. Third one, ULIP. So second and third is very special provision. Only first one will apply to us. Property of any kind. Property of any kind will exclude 4 items. Personal effect, stock in trade, gold monetization scheme bonds, and rural agricultural land. But personal effect will not have jewelry, archaeological collection, painting, drawing, etc. because they will be called as capital asset. That's all. So land, building, everything will come under which one? Property of any kind. Tangible, intangible, correct? Movable, immovable, everything will come under the first point only. Very easy. So that particular capital asset when I am selling, sale of capital asset, then what will happen? Transfer. Ultimately, capital gain will be what? Transfer of capital asset, T of CA. So first of all, if you are a capital asset, which we have discussed, then I have to see whether you are it is a transfer. First of all, if it is a capital asset, then I have to see if it is a transfer. T of CA. First question is it a capital asset? Second one, transfer. Then only I should see other things. What are the other things? T of CA is 1. What are the other things? What is the FPOC, full value of consideration? What are the expenses? And what is my capital gain? And once I get my capital gain, I should see for how long did I hold this asset. If I held it for a longer time, long term. Shorter time, short term. Based on that, what will I put? Tax rates I will impose. I will impose tax rates. Got it? So first one, sale of capital asset. So that capital asset when I sell it off, that will be called as sale of capital asset. Second one, exchange of capital asset. One is what? I sell that capital asset. One more is what? I exchange that capital asset with something else. Means what? One asset I will give you, one asset I will take back. So if I give you my house to you and in exchange I get the share, possible. Basically instead of buying the shares, I will give you my house. I will give you my immovable property and then you will give me my shares. And in amalgamation, my dear friends, what will happen? I'm just generally saying, shares of one company is given, shares of another company is taken. Exchange. So there are some things which are a transfer, some things which are not a transfer. But generally exchange of capital asset, is it a transfer? Yes, it is. No doubt about it. Third one, relinquishment of a capital asset or extinguishment of right therein. Relinquishment of capital asset or extinguishment of right therein. Relinquish means to give up. Extinguish means exhausted. So when in 2020, Reliance issued right shares. For every 15 shares, they gave one right share. So the market price was 1,600, but Reliance issued those shares for just 1,300 rupees. Right? So 1,600 rupees is worth 1,300 they were issuing for. Now let's say I have some, 100 shares, because of which now I've been offered 15 right shares. There's one share for every 15. So I have got not 100 shares. Let me say I have got around 1,500 shares. I have got 1,500 shares. So now I have been offered 100 right shares. Those 100 right shares I have entitled to buy. I have an entitlement to buy those shares. I don't want to buy. What will I do? I will give up that right. I'll say no, I don't want to buy. I will transfer that right to you. I'll say I am selling my right shares to you. I am selling it to you at 200 rupees per right share. You please give me the money. Then you can go buy from Reliance. That makes a lot of sense because for you, you are buying the shares at 1300 and you are paying me you are paying me 200 rupees. You are paying me 200, you are paying Reliance 1300. So ultimately, how much are you paying overall? 1500. But what is the actual market value of the share? 1600. If you want to go from the market and buy, it is 1600. But if you are buying it from me, the right to buy, you are buying from me. The right to buy the shares, you are buying from me. And then you are transferring you are buying the shares from Reliance. The right to buy the shares, you are buying from me at 200 rupees per right. And then you are using that right to then go and buy the shares in Reliance. So 1300 you are paying Reliance, 200 you are paying me, 1500 you are paying overall. But if you buy the shares from outside, that is 1600 rupees. So it's always better to go with this. For me also it's good. I was entitled to get 150 shares. But that entitlement only I sold, or 100, whatever it is. I was entitled to get 100 shares, entitled to get 150 shares. That I sold to somebody. For me, I am getting that full money, 200 rupees into 100 shares. 200 rupees into 150 shares means right to buy the shares. 200 rupees per right for buying the shares. 200 rupees per right for buying the shares. It can be 100, 150, 200, whatever. But 200 rupees I'm charging. Yes, is it a transfer? 100% yes, it's a transfer. No doubt about it, it's a transfer. Third one, relinquishment of right. Fourth one, conversion of capital asset into stock in trade. You had lot of jewelry at home, capital asset. Suddenly you will bring the jewelry and open a shop. Jewelry was 1990s. Jewelry was 1990s. You brought all the jewelry and today in 2025 you want to sell it. Today you start a business. Today when you start a business, you can sell it tomorrow, day after, 3 days later, 4 days later, 1 month later, 2 years later, I don't care. So what happens next? What happens next will obviously be PGBP. So what did I tell you in the example? In 1990, you had some jewelry and in 2024 you opened a shop. Kudla Jewelry Shop, AJS. This Kudla Jewelry Shop, now you are selling the jewelry, fancy jewelry it is. Now the moment you convert, it was a capital asset, you convert it to what? Stock in trade. Here when you start selling guys, this will be PGBP, obviously. But even when you convert, you didn't do anything. You just got it from home and put it in a shop. That's all. Nirmala madam is telling that putting that from the house till here, that also is a transfer. Deadly. You bought the jewelry for 1 lakh. That jewelry is worth 90 lakh today. Tomorrow, this 90 lakh worth of jewelry, you are selling it for 120 lakh. Nirmala madam says, no problem. 120 lakh minus 90 lakh, 30 lakh will be PGBP. No doubt about it. But she will ask you, what about all these years which you kept as capital asset? Today you converted to stock in trade. Isn't that a capital appreciation? Yes. That is why the moment you open a shop, I will deem it to be a transfer. No deeming. I'll insert in the Bear Act only that it is a transfer. You cannot argue with me. And the difference between, this is a FMB, fair market value on that day is 90 lakhs. Cost you bought it for was 1 lakh. 90 minus 1, 89 lakh rupees. 89 lakh rupees is what I will charge as capital gain. Beauty. Very good provision. Conversion of capital asset into stock in trade is what? Transfer. Reverse case. Conversion of stock in trade into capital asset is PGBP. You saw that example, Casa Grande example. I had an entire building, 2 flats were there, 2 flats I converted into office space. So that FMB will be PGBP. Here ulta. FMB at the time of conversion will be capital gain or will be FVOC basically, full value of consideration, minus the cost will be my capital gain. Understood? Yes. Next, compulsory acquisition of a capital asset. Compulsory acquisition of a capital asset. So I had a house, metro was being constructed. They came and took over half the house. Was it voluntary? No, involuntary. I was not ready. I was not interested also in selling. They have compulsorily acquired my capital asset. Completely acquired like that. Now today, what do? I've acquired the capital asset. Now nothing can be done. What do? That act of acquisition, let's say it happened in 2024. Is it a transfer? Yes. Government will give me compensation for compulsorily acquiring. Government will give me compensation for compulsorily acquiring the property. Is that my full value of consideration? Yes. That is compulsory acquisition of capital asset. Next. Allowing possession of an immovable property. Allowing possession of an immovable property. Mr. A is the owner of a property. B is the new owner. A created an agreement to sell or agreement for sale on 16 July 2020 worth 50 lakh. That day it was 50 lakh, right? Now, he has given some basic advance payment. And on 17/9/2022, Mr. B has taken possession of the building by paying 20 lakh rupees. Let's say selling it for 50 lakh rupees. I gave 20 lakh rupees and took possession of the building. No problem. Generally, possession happens only after you give the registration. After registration is done, but some people will allow possession also. No problem. But ultimately, you will become the true owner of the building only and only at the time of registration. Only at the time of registration, 22nd February 2025. So 50 lakh possession has been transferred. And then that possession has been transferred and then what? It has gone for registration. Registration happened on 22/2/25. Legally everything was done. But when is the date of transfer? On 17/9/22 when you got the possession or 22/2/25 when you got the registration? You are actual owner only on 22/2/2025. But for capital gain purposes, when is a transfer happening? Allowing possession of immovable property. That day only. 17/9/22. You are deemed to be an owner. This is given in the TOPA, Transfer of Property Act. There is a law called Transfer of Property Act. There it is said that it is taken into account. So you will have to take it there. Next, transfer of shares of any cooperative society. So if those of you are living in apartments, apartment building, this entire apartment will be handled by a cooperative society. You may be the owner of this flat, but no, everything will be transferred and it will be owned by the cooperative society. And cooperative society will give you share in the cooperative society. So do you own a house? No, you own a share in the cooperative society. So when the new buyer comes and he wants to buy your house, he will not buy your house. He will buy the share. When he buys the share, is it like he's buying the house? Yes. So if you see, same thing. Transfer of shares of cooperative society. When the share is sold, house is also sold. It is a transfer. Zero coupon bond. We have already seen this. ZCB. Zero coupon bond. Something which is at 70 rupees is redeemed at 100 rupees, 30 rupees is the discount. So at the time of redemption, where I'm giving you 100 rupees, is it a transfer? Yes. 30 rupees will be my capital gain. At the 100 rupees thing, it will be a transfer. This is the beauty of the definition transfer. See, sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capitalization in stock in trade, ZCB, possession of immovable property, acquiring shares, of becoming a member of a cooperative society. Everything is covered. Alright, guys. So now we come to a very important area that is called types of capital asset. Types of capital asset. Now this has been amended in the year 2024 Finance Act, which means very, very important for from May 25, November 25 onwards, obviously. So extremely important for these exams. CMA also, CMA 25, important. Long-term capital asset, 229 AA. Short-term capital asset, 242A. So let's see. So, first of all, any security. So types of capital asset, I can divide into A, B and C. Point number A, any security. Earlier it used to be other than units, but now it is including units. So there are three categories, A, B and C. A used to be 1 year, B used to be 2 years, C used to be 3 years. Now the concept of 3 years has been completely removed by Nirmala Madam from 23rd July 2024. From 23rd July 2024, there is no concept of 3 years. Now, the short term and long term is either 1 year or 2 years. That is either 12 months or 24 months, nothing more, nothing less. It is either 12 months or 24 months, nothing more, nothing less. So, it's either 12 months or 24 months, simple. First, any security. Types of capital asset, any security other than units. Other than units. Now that other than units is removed. As of today, any security including listed units. It's what now? Any security including listed units from 23rd July 2024. Listed in a recognized stock exchange in India. NSE, BSE. Right? Any security including units listed in a recognized stock exchange in India. Second, units of Unit Trust of India. Third one, units of equity oriented mutual fund. Fourth one, zero coupon bonds. For everything it is 1 year. For everything it is 1 year. Then many things from here have gone to the left side, right side. All listed. Listed units including the business trust units. Guys, earlier business trust units was covered under other asset because business trust unit cannot be called as a security because it is a unit. Unit is a security, but here specifically they have told other than units. So it could not be covered under type number A. It used to be under other asset. But now what did I say? Even a unit of listed business trust, or I would say listed unit of a business trust, will come under point number A. Any security including listed units from 23rd July 24 listed in a stock exchange in India, which is covered under NSE or BSE. Second one, units of Unit Trust of India. Third one, units of equity oriented mutual fund. Fourth one, ZCB, 1 year. So period of holding is what? 1 year. If it is less than or equal to 1 year or 2 years, as the case may be, short term capital asset. More than 1 year or 2 year, long-term capital asset. Second one, immovable property. Second, shares, that is equity or preference of company other than that covered under Part A. This is what? Unlisted shares. Other than that covered in Part A will obviously be unlisted because Part number A is what? Listed in stock exchange in India. Anything other than listed in stock exchange in India will be Part number B. As simple as that. Right? So any security other than units. Now it includes what? Listed units. Units of Unit Trust of India. UTI. Units of Equity Oriented Mutual Fund. Fourth one, ZCB. 1 year. Next, immovable property. Equity or preference shares of company other than that covered in Part A, 2 years. Third one, other assets, 3 years. Now, 3 years is not there now. 3 years is either in A or B. Which will be in A? Listed units will be in A. That's all. Everything else which was there in 3 years will now be in B. Jewelry. Is it immovable property? No. Jewelry was earlier 3 years period of holding. Now jewelry has become 2 years. Painting, archaeological collection, everything was 3 years before. Now 2 years. That's what I'm trying to tell. So this is the biggest change in Finance Act 2024. So examples, house property, jewelry, equity shares of Reliance Industries Limited listed in BSE, preferences of Infosys listed in NSE, shares of PJ Private Limited which is unlisted, unlisted units of UTI, debt-oriented units of Sheila Mutual Fund listed in BSE, shares of Tesla Incorporated listed in US Stock Exchange, ADR of Infosys Limited in Nasdaq, equity-oriented mutual fund of KSA Mutual Fund, units of business trust which are listed. You need to tell me what will be the period of holding for these things. Period of holding for these things. Come on. Then check your answers. House property, 2 years. Jewelry, earlier it used to be 3 years. Now it is 2 years. Equity shares of Reliance Industries Limited listed in Bombay Stock Exchange. Listed 1 year. Preference shares of Infosys listed 1 year. Shares of PJ Private Limited unlisted. Unlisted 2 years. Shares of PJ Private Limited unlisted 2 years. Unlisted units of UTI, any units of Unit Trust of India, whether it is listed or unlisted. See here, point number 2, units of Unit Trust of India. I never said it is listed. Listed or unlisted units of Unit Trust of India, it is 1 year. Generally, we may make a mistake here. Debt-oriented units of Sheila Mutual Fund listed in BSE. Earlier, it used to be 3 years because units were not covered. Now, all listed units are covered under point number A. So, debt-oriented units of Sheila Mutual Fund listed in BSE, 1 year. Shares of Tesla Incorporated listed in US Stock Exchange. Shares of Tesla Incorporated listed in US Stock Exchange, 2 years. Why? Why 2 years? Because it is not listed in Indian Stock Exchange. It is not listed in Indian Stock Exchange. It is listed in US Stock Exchange. US Stock Exchange. Understood? ADR of Infosys listed in Nasdaq. ADR of Infosys listed in Nasdaq, 2 years. Why 2 years? Because it was earlier used to be 3 years. Now everything is come under 2 years. Equity oriented mutual fund of KSA Mutual Fund, which is unlisted. Since it is all equity oriented funds will be covered under 1 year only. So it's 1 year. Units of business trust which are listed, as we have discussed, it is 1 year. Then you can write down bonds, debentures, gold. Last point. Bonds, debentures and gold. Earlier bonds, debentures and gold used to be 3 years. Now it will be 2 years. Simple. This is the first amendment. This is the first amendment. First amendment, to understand what do you mean by all these things. First amendment, guys. So once you figure out the period of holding, this is what it is. Same thing I have given. Then there is equity oriented fund. Now regarding this 50AA market linked debenture, we will discuss, to be discussed. Discuss it later, no problem. Unnati, it is listed in stock exchange. All units listed in stock exchange will be 1 year. Here see, including listed units, any units listed in stock exchange. Any units listed in a stock exchange. But if you take it as mutual fund, yeah, you can take it as 2 years also. If it is taken as mutual fund, then yes. Since I am taking this only, whether it is equity oriented or debt oriented, any units listed in BSE will be what? 1 year. All listed units will be 1 year now. Completely she has changed the dynamics of period of holding. Got it? Anyway, now this part here, this 50AA we will see later, guys, because I have to link it with something else. We will see that later. I will explain this later, no problem. So the land is held for more than 24 months, but building is constructed less than 24 months. Land becomes long term, building becomes short term. I should calculate it accordingly. Period of holding of an asset includes fraction of a day. There is an interesting point. Period of holding would begin on the day when the SSE became the holder of the asset and end on a day before the completion of this 36 months. You can delete 12 or 24 months. Land was held by NSE on 18/11/2019. It will be long-term asset by the end of 17/11/2021. 1 day before. Even if the asset is transferred on 18/11/21, it shall be still considered as long-term. Even if the land was held even for a fraction of a day on 18/11. This is an important point. Alright, guys. 50AA we will see shortly. Yes. Very simple. For a short-term capital asset, what will I consider? I will consider the full value of consideration FVOC minus the transfer expenses. So whatever, for example, if I'm selling a house which is short-term, let's say within a year only I'm selling, whatever the consideration I receive, I have to take it into account less what? Transfer expenses, brokerage, stamp duty, all those things. Then I'll give my net consideration. From the net consideration, I should subtract cost of acquisition, cost of improvement. So cost of acquisition is the cost that cost that I had spent, money that I had spent to buy that particular building, cost of acquisition. Cost of improvement is all the capital expenditure that I have incurred on it. For example, if it's a building, it may be renovation, repair, painting, all those things. So full value of consideration minus transfer expenses is net consideration, less cost of acquisition, less cost of improvement. Capital expenditure will be my short-term capital gain. Will be my short-term capital gain. STCG, short-term capital gain. That's about it. Then long-term capital asset will what? This is short-term capital asset. Long-term capital asset. For long-term, one additional thing that I generally used to get is indexation. Full value of consideration minus transfer expenses, net consideration minus I will get indexation. Index cost of acquisition and index cost of improvement. Indexation is just bringing that into taking inflationary measures into account. There is something called as a cost inflation index. Taking that into account, I'll bringing it into the current value. So if I had bought an asset in 2015 and I'm selling it in 2024, so from 2024 to 2015 to 24, I have to put the indexation in place. So that indexation is what I need to see here. Means what? Whatever I bought in the year 2015, the value will not be the same in 2023. So I have to bring that cost to inflation. Now this particular concept also, there is a change in Finance Act 2024. Nirmala madam, what did she do? She earlier for long-term capital gain, the rate was 20%. The tax rate was 20%, but indexation benefit was given. In Finance Act 2024, she removed the concept of indexation at fully. And the tax rate was reduced to 12.5%. Tax rate was reduced to 12.5%. That will be my long-term capital gain. But again, people started fighting, saying that if I have a family heirloom, family house, 40-year-old family house, if you remove indexation, then on the difference, my father bought it for 10,000 rupees 40 years ago. Now the value is 10 crore. You want me to pay tax on 10 crore minus 10,000 at 12.5%. No, please give me indexation. So only for residential property, she has given indexation. All that I will tell you, don't worry. I'm just giving you the gist of the story. We still haven't done all that. Don't worry about it. So we'll do a master chart whereby you will be able to understand it in a very, very better way. Okay. So there is a concept called indexation. So basically indexation is what? Cost of acquisition into index for the year of transfer divided by index for the year of purchase. Same. Index cost of improvement is what? Cost of indexation, cost of improvement, sorry, into index for the year of transfer divided by index for the year of improvement. So the index values are all given here. Yeah, here page number C14. So the indexation for our year 24-25 is 363. So if I bought an asset for 10 lakh in, let us say, 1920, I'm selling it in 24-25. So 10 lakh into 363 by 289. 10 lakh represents 289. How much does it represent? 363 is what I need to calculate. 10 lakh into 363 by 289. So I should see. 10 lakh into 363 by 289. You see here I have given page C11 down. Only for transfers which take place before the 23rd day of July, indexation will come. On or after 23rd July 2024, indexation benefit is not available. Indexation benefit is not available. No indexation benefit, my dear friends. Here, should I remember this date in the examination? 100% yes. Especially for May 25, November 25, this date is of utmost importance. If anything is bought or anything is sold before 23rd July, indexation is available. If anything happens after 23rd July, indexation is not available. I'll explain that later, no problem. So ultimately, you have to give exemptions also, which we'll see at a later part. And ultimately, it will be net short-term capital gains or net long-term capital gains. Now, what if I had purchased the property before 1/4/2001? If I had purchased the property before 1/4/2001, the indexation rule only came in on 1/4/2001 here. The index was formed only in 1/4/2001. So what if I had bought the asset in 1980, 1990, before 1/4/2001? Then what? Cost of acquisition, FMB as on 1/4/2001, whichever is higher I should take. So guys, cost of acquisition in 1990 I had purchased for 10 lakhs. But I should start only from the year 2001 because before that index only was not there. In the year 2001, the FMB of that house which was bought for 1990, FMB is 15 lakhs. So obviously what should I take? Cost of acquisition 90 lakhs, sorry 10 lakhs or FMB 15 lakhs, whichever is higher, 15 lakhs. So any cost of improvement that happened between 1990 to 2001 must be ignored because when I am taking the FMV as on 1/4/2001, it will include everything. It will include the property upgradation. What all have I done with the property? Have I recoated the paint? Have I renovated it? Everything will be taken into account only and FMV will be derived. FMV is given by a valuation officer. So valuation officer only will give all the details. Till which year? 1st April 2021. So I should take which one? Cost of acquisition or FMB as on 1/4/2001, whichever is higher. Whichever is higher. So one interesting thing used to happen. What used to happen? 1980 property value was 10 lakh. 2001 indexation came. 2024 I am selling. Let's say I'm selling it in April 2024. Indexation is applicable. I have to take the cost or FMB, whichever is higher. So when I'm making my full value of consideration, let's say I'm selling this for 3 crore. I'm selling this property for 3 crore less cost of acquisition. This figure, whatever I subtract, is either 10 lakh or this amount, whichever is higher. I will understand that the FMB has now become 15 lakh. I'll go to a valuation fellow. Valuation guy will say, sir, according to me, in 2001, the FMB would be 15 lakh rupees, sir. It is nothing less, nothing more, 15 lakhs. Now, if I subtract 15 lakhs here, I still have to pay tax on 2.85 crore. I will bribe the FMB guy, bribe the valuation officer and say, sir, please make it 25 lakhs, sir. I'll give you extra money. Or make it 30 lakhs, sir. Who will care? Who will know? You are the valuer. You make and give, no. Add some parameters and make 30 lakhs and give. So that I will make 30 lakhs here, at least 2.7 CR. I will pay 15 lakhs less, sir. Tax on 15 lakh less. Please do it. Cheating. Cheating. This cheating used to happen till Finance Act 2020, as recent as 5 years ago. Nirmala madam said many people are hiking up the FMB. How is it possible? So she said, now I will introduce one more thing. You can increase the value here and all, I will understand. Because, you will go to the valuer and pay money. But can you change the value recorded in the government sub-registrar office? No. Go to the sub-registrar's office and open the records of 2001 and tell me what would be that particular value of that property that time, area. That is called as stamp duty value, SDV. When I open the government register, stamp duty value is coming up to 11 lakh rupees. Stamp duty value is 11 lakh, or let's say stamp duty value is 16 lakh. Stamp duty value is 16 lakh. Stamp duty value is 16 lakh. And you are showing 30 lakh easily. So she added one more point. She said, okay, it is cost or FMB, whichever is high, no problem. But FMB also has to be compared with SDV, deadly point. So she made what point now? SDV or FMB, whichever is low. I repeat, SDV or FMB, whichever is low. And cost or that figure, whichever is high, deadly. I repeat, FMB, whatever you have claimed, and SDV, whichever is low, you have claimed 30 lakhs. 30 lakhs or 16 lakhs, whichever is low. And that low amount and 10 lakhs, whichever is high. So you see, dialogue she put. FMB as on 1/4/2001 cannot be more than SDV where SDV is available. Deadly dialogue. So step number 1, FMB as on 1/4/2001 or SDV as on 1/4/2001, whichever is less. FMB as on 1/4/2001 or SDV as on 1/4/2001, whichever is less. And then cost or step number 1, whichever is more. Cost or step number 1, whichever is more. There ends the matter. Understood? Very good point. Very good amendment. And I should take the registration period of holding. Everything will be from the date of buying to the date of registration only. As I told you, I first make an agreement for sale in 1 year. I may take possession in 1 year. Final registration happens, sale deed some other year. The stamp duty value of which date should I take? Lawmaker says stamp duty value can be taken the day you pay some advance. But that advance should be paid through bank account only. Some advance you pay only through bank account, that only I will allow. So for example, in 2023, the stamp duty value was 50 lakh. I wanted to buy this house. I paid some advance, 1 lakh through bank account. Final registration only happened in 2025. That time STV had shot up to 70 lakh. So my choice, I can take 50 lakh also, 70 lakh also, my choice. Right? So what will I take? I will take obviously whichever is less, no? When I'm talking about taking it as a sale, FEOC. So anyway, we'll discuss this part later, don't worry. But what I'm trying to tell is, when you pay an advance through bank account, even on the date of agreement for sale, you can take that STV value. But anyway, here we are talking about the cost portion. Cost portion comes here, guys. Cost. FMB as on 1/4/2001 cannot be more than SDV, where SDV is available. So step number 1, FMB as on 1/4/2001 or SDV, whichever is less. Then cost of step number 1, whichever is higher, I should take. Should take these items. Right? And all expenses in connection to transfer like advertisement, brokerage, legal expenses, everything will be taken into account. So cost of acquisition, anything before 1/4/2001 should be ignored. Only after 1/4/2001 should be taken into account. For certain things, cost of acquisition shall be nil. We will discuss this later, but you can just go through. Because goodwill, etc., there is no thing for 11 items. Indexation will always be given. Except now, where they have told indexation benefit will not apply after 23rd July 2024. Cost of improvement also, painting, regular touch-up, etc. That is not called, routine expenses are not cost of improvement. Cost of improvement genuinely means renovation, complete refurbishment, those things only. Okay. So moving on. Yes, in case of certain specified modes of transfer of capital asset like gift, etc., basically cost of improvement of previous owner also will be considered. When I make a transfer also, cost of improvement of previous owner will always be considered. Cost of acquisition also will come from the previous owner in case of gift, etc. Business trust we will see later because it comes part of the business trust. Yes. Scope and year of chargeability. Generally, guys, always remember general rule. General rule. Whenever a asset has been transferred, whenever a transfer has occurred, that year only taxation will come. Year of transfer and year of taxation both are the same generally, but there are these many exceptions. 1, 2, 3, 4, 5, 6, 7. Under these 7 exceptions, the year you transfer is different from the year of taxation. The year of transfer is different from year of taxation. These are the 7 items. So in that, we will see. This part we'll see later. Do you believe? Other things we can. This also we'll see in AOPBI, we'll see, no problem. But 1, 2, and 6, 7. We'll do it off now. 1, 2, 6, 7. 4 items. So very simple, guys. When an asset is destroyed, that is transfer. Remember, extinguishment of rights. When an asset is destroyed, your rights are gone. Destruction of asset gone. But that is the year of transfer. But you have to wait for the insurance company to pay you compensation or give some same asset back. So when they give you some compensation, is it transfer? Transfer is the day it destroys, only it is transfer. But when will you pay tax? You will pay tax only when you get some money. That money can come 6 months later, 8 months later, 1 year later, whatever it is. That insurance money till it comes, you cannot tax it. So that's why year of transfer is different from year of transfer is different from year of taxation. Similarly, conversion of capital asset into stock in trade. I told you, from the jewelry from my home, I will bring it to the shop and keep. That year was only transfer. But can I pay tax? I've just took it physically from my home and kept it in the shop. It's transfer for sure. Will I pay tax? On what will I pay tax? I gave you an example. 10 lakh worth of jewelry is now 90 lakh. On what will I pay tax? I have to pay tax on the difference. I totally agree. But where is the money? So Nirmala madam says, no problem. When you start selling that jewelry, that time you will have to pay tax. No problem. So when you sell the jewelry, you will have to pay tax. When you sell the jewelry, it will be PGBP anyway. Right? I'll give you an example, you'll understand. Similarly, when a capital asset is compulsorily acquired by the government, it will be acquired today, but I'll get the money 3 years later. So when should I pay tax? 3 years later. So these are some of the provisions, but let's see the example of capital asset into stock in trade. Okay, there is an auntie called Sheila auntie with all jewelry here. Previous year, 2001, 2002 is her cost. She had bought it at just 20,000 rupees. Now Sheila auntie has transferred the jewel. Means what? It's given off to Mr. Atesh, who's a jeweler. Atesh Jewelers. She has converted it into stock in trade. She's sitting there, converting into stock in trade. In previous year, 1819. But the fair market value of that was 60,000 rupees. She has just taken it from home and kept it in the shop. That's it, nothing else. Is it transfer? Yes. But where will I pay tax? I can't pay tax, no. I don't have money. When this stock in trade is sold in the year 23-24, sold for 80,000 rupees, then 80 minus 60, then only that 20,000 is PGBP, my dear friends. 80,000 minus 60,000, that 20,000 is PGBP because I'm selling that. But what about 60,000 minus 20,000? 40,000, that is also transfer, no. When will I pay tax? I will pay tax not in 1819. I repeat, I will pay tax not in 1819, but I will pay tax in 23-24. I will pay tax not in 1819. I will pay tax in 23-24. That's the beauty. Transfer happens in 1819. Transfer happens in 1819, but the taxability is postponed. Taxability is postponed to what? 23-24. Taxability is postponed to 23-24. So general rule, capital gain will be in the year of transfer. But in 45 to this example, year of transfer you should ignore. Conversion of capital asset into stock in trade will be the year of transfer, no problem. But tax is only when the jewelry is sold, that is 23-24. Only when it is sold. So there is one more concept, let's say. Land of 10 lakh rupees. Okay, land of 10 lakh rupees. in financial year 2000 to 2003 is converted to stock in trade on 1/4/2015. On 1/4/2015. FMV of the land is 150 lakhs that day. FMV of land is how much? 150 lakhs. You will convert that land into flats. You will make flats. Is it cost of improvement? No. I've already converted it into stock in trade. Where is it cost of improvement? It's pure business expense. I will make 20 flats, guys. I will make how much? 20 flats I will make. So at the end of the year, 15 flats are sold, 5 flats are stock in trade. 15 flats are sold, 5 flats are stock in trade. Okay. So 15 flats will be what? Purely PGBP. 5 flats stock in trade. Selling price per flat will be 20 lakh rupees. Selling price per flat will be 20 lakh rupees. Cost of each flat. This is what? Making the flat. Cost of making the flat. 8 lakhs. So 20 lakh will be what? Selling price of the flat. Cost of flat is 8 lakhs. So profit per flat is it 12 lakhs? You think about it. At the end of the year, how many flats are sold? 15 are sold. Cost inflation index in the year 2000 to 2003 is 105. 23-24 is 348. 15-16 is 254. I've given you the cost inflation index. You need to tell me in the year 23-24 what is PGBP, what is capital gain. Guys, PGBP and capital gain both will come in 23-24 because in 23-24 the flat is sold. When is the year of transfer? This one. What should be the period of holding? 2002, 2003 to 14-15, guys. Period of holding will be only till it is converted. When is transfer? Conversion. But when is the tax? Tax is postponed. Tax is postponed to what? 23-24. This is actually an examination sum. Actually an examination sum. Please calculate capital gain and PGBP and tell me. This is the entire question. Land 10 lakh. FMB as on date of conversion 150 lakhs. On that land, how many land value is 150 lakhs? On that land, how many, flats were constructed? 20 flats. What is the cost of each flat? 8 lakh. What is the selling price of each flat? 20 lakh. How many flats were sold? 15. So what is the PGBP? 15 flats sold. What is capital gain? Capital gain is for what? Conversion, land. Come on, guys. Try. Exam question. Try. Come on. This would be the answer. Let's see how many of you have got it right. 15 flats sold PGBP. See, PGBP will be 15 into 20 lakhs, 3 crore. Less cost of flats. One you would have directly taken this. 8 lakh per flat into 15 flat, you would have taken 1.2 crore for the building. I don't know if you took for the land. This is the main mistake people do. I don't know if you took for the land. Land is how much? 15 crore into 15 by 20. 15 into 15 by 20. That is 1 crore 12 lakh 50,000. This is for the land. 3 crore minus 1.2 crore minus 1 crore 12 lakh 50,000 will be how much? PGBP 67 lakh 50,000. What will be the PGBP? 67 lakh 50,000. 3 CR minus 1.2 CR minus 1.1250 will be 6750. This you may not have taken. That is one mistake that we do. This is for PGBP. Then capital gain. Capital gain is how much? FMB as on the date of conversion 1.5 CR. Less index cost of acquisition. I told you indexation will come from 2000 to 2003 to 15 only. So 254 by 105. This is for the entire land. But I should take only proportionate because in that land only 15 out of 20 has been constructed. So I should take 1 crore 25 lakh 80,952 into 15 by 20. Into 15 by 20. Ninety-four lakh 35,714. So as I told you, general rule in taxation is what? Taxation is in the year of transfer. Exception, these things. Conversion of capital asset into stock in trade, compulsory acquisition, damage, destruction, joint development, all those things. Compulsory acquisition we'll do after the break, but then I would want to do the damage or destruction of a capital asset. So guys, when the company, when you go for damage or destruction, yeah, destruction or damage of the capital asset, general rule is what? The year the asset gets destroyed or damaged, that is not, I mean, that is a transfer, however, but when will you get the payment? Whenever you get the payment, insurance money, that is the year you will pay tax. Generally, destruction or damage is not a transfer, but if it happens due to natural calamity, enemy attack, fire, riot, force majeure events, then insurance compensation, whenever you receive it, it will be taxed in the year of receipt of insurance compensation. That is the thing. So on the other hand, what if you receive a new asset? So they say FPOC will be either insurance claim received or FMV of the new asset received. Minus transfer expenses, minus indexation, you will get short term or long term. So either insurance claim received or FMV of the asset received. This is the other point, 45(1)(a). So here 45(1)(a) and 45(2) along with the example which is there. Conversion of capital asset into stock in trade. Conversion of stock in trade to capital asset, we discussed it in PGBP, section 28. And the entire jewelry, that FMV here, is valued as per rule number 11UA, where inventory is converted. So it's basically, we'll go to that particular rule and discuss that. The next part was what? Compulsory acquisition. Check it out. I'll explain all the variations of compulsory acquisition and then, you can go through that. So guys, let's see. Cool. So compulsory acquisition example. So the cost of a house in the year 2001-2002 was 3 lakh rupees. That was compulsorily acquired in the year 1516. Compulsorily acquired in the year 1516 by the government. So the law suggests that the year of transfer will be 1516. Year of transfer will be 1516. Now this one has been, what do you say? The compensation for this, however, is received in 2 tranches. Means 2 times. One is in 22-23. Compensation was received 30 lakh rupees in 22-23. Let's call it as initial compensation. And then additional compensation was taken in 25-26. You did not like the initial compensation given, so you went to the court. Court ordered additional compensation in the year 25-26. So that will be 20 lakh. And initial compensation would be 30 lakh rupees. Cool. So 0102 and compulsory acquisition 1516 happened. Year of transfer 1516. Year of tax C, when the compensation you receive it 30 lakhs. Additional will come to that now. Yes. So full value of consideration 30 lakh minus transfer expenses, net consideration 30 lakh. Less indexed cost of acquisition. When did I get the cost? 3 lakh, 2001-2002. And even though I am paying tax in 22-23, that is only postponed, but the calculation should be as on which day? 1516. So FPOC less transfer expenses, net consideration 30 lakh, less index cost of acquisition 7 lakh 62, 254 into 100. So long-term capital gain is 22 lakh 38,000. That's okay. So now general rule of compensation is what, guys? Initial compensation, how will I calculate? Full value of consideration, that is compensation, less cost of acquisition or index cost of acquisition, less cost of improvement or index cost of improvement, then short term or long term as the case may be. Short term or long term purely depends on this one. For how long did you hold it? Correct? It is from the year of purchase to the year of compulsory acquisition. Year of purchase to the year of compulsory acquisition. That's fine. Now, if I'm not happy with the initial compensation, I can go for additional compensation or enhanced compensation. So additional or enhanced compensation is also called as additional compensation. So that compensation, will I again get cost of acquisition? No, because I have already subtracted. No, I have taken the full value of consideration. I have already subtracted the cost of acquisition. I have already subtracted the cost of improvement. I will not take it anymore further. Only additional compensation, whatever I have, there I will subtract what I call as litigation charges. So full value of consideration minus litigation charges. Why litigation charges? Because I fought in the court of law to get that extra money. I fought in the court of law to get that extra money. So that additional compensation less litigation charges will be my short term or long term. This short term, long term also totally depends from the date of acquisition to the date of transfer. From the date of acquisition to the date of transfer. 0102 to 1560. No cost of acquisition here because it's only litigation charges. This is all fine. Now they will ask you few questions, variations. In my example here, 30 lakh is the compensation received. How much is the compensation received? 30 lakh rupees. Correct? 30 lakh is the compensation received. Now what if I get it in installments is the question. In my first example, 22-23 only I got. My first example, 22-23 only I got. What if that also is broken down into installments? Some I'll get in 22-23, some more I'll get next year, then the next year, like that. So, check this. 30 lakh rupees. Initial compensation received in installment, 30 lakh. In that 20 lakh I got in previous year 22-23, 5 lakh I got in 23-24, another 5 lakh I got in 24-25. How much will be taxed in 22-23 is the question. Initial compensation 30 lakh I received, no? How much will it be taxed in which year? Will it be taxed 20 lakh in 22-23, 5 lakh in 23-24, 5 lakh in 24-25? Answer is no. How much will be taxed in 22-23? Very simple, guys. Full 30 lakh rupees. Full 30 lakh rupees will be taxed in the year 22-23. Even though only 20 is received. Even though only 20 is received. In the first year, guys, when the government says compensation is 30 lakh, it is they have already agreed. There is no second thought about it. Only payment will be delayed. That's all. So Nirmala madam is telling, first of all, I gave you a lot of time. Though the transfer happened in the year 15-16, I postponed the taxation till you received the money. And when they are giving an installment, first installment will be always very high. First installment will be high. So you can easily pay the tax from the first installment. So basically, the tax will be on full 30 lakhs. In which year? In 22-23 itself, even though only 20 lakh is received. That is what you need to understand. It will be fully taxed. Full 30 lakh will be taxed in 22-23, even though only 20 lakh is received. Even though only 20 lakh is received. Now, if you get additional compensation, well, initial compensation over, guys. This is variation number 1. Now, additional compensation, that is for fighting. I fought it and got it, 20 lakh. So that obviously it will be taxed in the year when you receive the additional compensation. But that also, if I get it in installment, if additional compensation also I receive in installments, 10 lakh I received in 25-26, 6 lakh in 26-27, 4 lakh in 27-28. Guys, initial compensation is decided by the government. Additional compensation is decided by court. So there is a possibility that when the court has given an additional compensation of 20 lakh and they have asked the government to pay 10 lakh in 25-26, 6 lakh in 26-27, 4 lakh in 27-28, there is a possibility that government also can go for appeal. This is not like the final decision, right? That is why, when will it be taxed then? Like for example, I receive 10 lakh in 25-26. Before I receive 6 lakh, government fellows can go for appeal. So is it fair for Nirmala madam to ask me to pay tax on the entire 20 lakh in the year 25-26? No. So this rule is, it will be taxed as and when I receive the money. It will be taxed as and when I receive the money, since the payment is not sure and it depends on various facts. It will be taxed as and when we receive the money, since the payment is not sure about. I'm not sure about the payment here. And it depends on various facts of the case. Correct? Taxed when it is taxed, as and when I receive it, since the payment is not sure and depends on various facts. Got it? If interest is received on delayed payment of compensation, obviously because this compensation will take years, can I get interest on delayed payment also? Yes. If that be the case, it is taxable as IFOS in the year of receipt. If interest is received on delayed payment of compensation, it is taxable as income from other sources in the year of receipt. So taxable amount is what? Interest into 50%. There is a 50% standard deduction. Interest is not on accrual basis. Interest is on receipt basis. Interest is not on accrual. Interest is on receipt. Now there are other variations. Variation number 3. There is something called as interim compensation. What is it called? Interim. Interim is a temporary order. This will only come in enhanced compensation. Initial compensation, I got 30 lakhs. There ends the matter. Enhanced compensation, I have asked for 20 lakh. Now, enhance. First of all, I'm aggrieved. I'm saying 30 lakh that you gave me is peanuts. That property is worth 50, 60 lakhs. At least give me 20 lakh more. So, interim compensation is given at the time by the court just to appease the petitioner. Petitioner is very angry. I want 20 lakhs more. Now, if I delay that further, he'll get agitated. So I'll ask the government. Government is on one side, petitioner is on the other side. I'll ask the government, boss, C is asking for 20 lakhs more. How much are you ready to pay immediately now? Let him just keep quiet for some time. He's already agitated. Just give a little, some amount you give him now. Are you ready for some amount? Government will say, yes, sir, on 4-5 lakhs I can give, sir. So the court will tell him, bro, 4-5 lakhs I'll release you immediately. That's called an interim order. You have asked for 20. I'm releasing 5 now. Later I may fix, you have asked for 20. I may fix 17. I may fix 18. I may fix 10. I may fix 10. I may fix 12. That we'll see later. But 5 I'll give you now. Be happy. So in 20 lakh, no. 5 lakh is given immediately in a temporary order called interim order. In between the petition and the final order, in between one small order, interim order. Make sense? 15 lakh we'll see later. 15 lakh we'll see later. You may not get 15 lakh. You may get 10 lakh, 12 lakh, 13 lakh. I don't know. We'll see later. Because that case should go on. But he is agreeing to pay 5 lakh more. Just keep your mouth shut for some time. That is actually the concept of interim order. Now, interim order was passed in what? 1920, for example. Interim order for how much? 5 lakh. Compensation granted 5 lakh, received when? In 1920. Final order was passed for 12 lakh in 22-23. Guys, what do you mean by this? I claimed 20. Interim order 5. Overall order also was 12. 12 out of 20. I claimed 20. Interim order passed was 5. Final order was 12 out of 20. Means what? Extra 7 he gave. That's all. It's not that 12 plus 5. Don't get confused. When I say final order means the last order. I claim 20 lakhs. Final order 12 lakhs. In that 12 lakhs, 5 lakhs was given now, 7 lakhs will be given later. 5 lakhs was given now, 7 lakhs will be given later. Hope you understood. So final order was passed for 12 lakh rupees in the year 22-23. So let's assume 5 lakh was received in 1920 as discussed. 6 lakh out of the remaining 7 lakh, 6 lakh was received in 22-23. Compensation due to final order. 1 lakh was received in 23-24. Compensation due to final order. For the 6 lakh and 1 lakh, no tension. It is taxable in the year of receipt as good as variation number 2. It is taxable in the year of receipt. Interim order, though it is received in 1920, ideally it should have been the year of receipt, but only for this interim order, there is a variation. There is variation number 3. Variation number 3 overrides variation number 2. It is taxed when the final order is passed, guys. Deadly. Even though I received it in 1920, the taxation is postponed for this. Which year? In the year when the which final order was passed. Final order was passed only in 2023. There is a small variation only for this one. Generally, 5 lakh interim order was received in 1920. I should tax in 1920 because I already got the money. The government says no need. When the final order is passed, now the 12 lakh order, that time you pay. That time you pay for 5 lakh, remaining 6 and 1, whenever you receive, you pay. That is the idea. But guys, if the compulsory acquisition is because of Right to Fair Compensation Act, Right to Fair Compensation Act is passed by military, Air Force, Navy, to build a military base in that particular place, or to build a sports complex, which will be used by the government of India, government of Karnataka, whatever it is. In that case, when they take over the land, when they give you the compensation, it is exempt. Right to Fair Compensation Act, it is fully exempt. It is fully exempt. So this is about compulsory acquisition. Next, guys. Asset in a joint development agreement. So what happens in joint development, guys? You will have a land. Mr. A has a land. You will give it to a builder. B builders. So builder will take this land, construct building, and he will tell 4 flats is yours. I will give you 4 flats and I will give you cash. Both. Okay. So when the possession is handed over to the builder, land possession will be handed over to the builder. That is the day when transfer happens. That is the day when transfer happens. But the builder will pay cash immediately. That's okay. But flat also he will give. No. When will he give flat? After construction only. So when is the taxation postponed? When is the taxation postponed? Taxation is postponed only when you get the 4 flats. Is it date of handing over possession of the flats? Is it date of registration of the flats? Is it date of, construction? When is the transfer postponed to which date? Lawmaker says it is postponed. Taxation is postponed till the date you get something called as completion certificate. Till you get completion certificate. For example, land you gave it up in 2021. Completion certificate you got in 2024. So when is the transfer happening? Date of the completion certificate. Very simple. 2024. What about the cash that you got? 4 flats you got and 20 lakhs cash you got. Everything is taxed in which year? In the year 2024. When the completion certificate the builder gets for completing the building. That is this section. On the other hand, in between this, no, 21 to 24, you decide that no, I don't want the flats. Before the flat could come to you only, in the year 2022 only, you sell off that flat. You will say, in the next 2 years, flat is coming, now only I am selling it off, take it. Then when is it taxable? There is no benefit of you to waiting till 24. No. The day you sell it, that day only you need to pay. Simple as that. If you are waiting till 2024, good. If you don't want to wait till 2024 and 23 only, 22, whenever you sell the right, it is gone. What will be the cost of acquisition? What will be take the, consideration? What will you take? You will take the stamp duty value on the date of completions of stamp duty value will be taken. Stamp duty value. So, year of transfer, previous year in which possession of immovable properties transferred, that land. Year of chargeability, certificate of completion. Stamp duty value as on the date of certificate, plus consideration, if any, whatever you received. That is what is taken into account here. Very simple. Here also what is postponed? Taxation is postponed. There is an example here. When I give you time, you can read that. Partner AOPBOI will be in a separate concept altogether. This will be in a separate thing. Tax implications of AOPBOI. Done. So, moving on, my dear friends, let's come to, so this is the gist of the story. Destruction of capital asset. Destruction of capital asset. Year of transfer is the year of destruction. Year of taxation is when the insurance claim has been received. 45.2. Conversion of capital asset to stock in trade. Year of transfer where it is converted. Year of tax where the stock is sold. 45.5. Compulsory acquisition of a capital asset. Year of transfer is where you have compulsorily acquired. Year of tax is when you received the compensation. 45.5a. Joint development agreement. Year of transfer is where possession is handed over to the builder. Year of tax is where you have received the completion certificate either in part or in full. Now there are certain special provisions that we'll have to discuss with respect to the capital gains. What is this? First of all, there could be a chance where there is a person Ambi, he sells land to a guy called Onion. Value of the land is 70 lakh. Right? But the real value of land, if you talk about the entire fair market value, it's around 110 lakh. But then he decides that let me take into account only 70 lakh. So 70 lakh he will pay cash. Sorry, 70 lakh he will pay through bank account, 40 lakh he will pay cash. So he made the fair market value only 70 lakh, but in fact the actual value, if you think about it, is around 110 lakh. To curb this from happening, government came out with the rule saying that the stamp duty value, SDV, the stamp duty value itself will be treated as the full value of consideration. The stamp duty value, the SDV, that itself will be treated as what? FVOC, full value of consideration. However, there could be a scenario where SDV will be different from FVOC. So, or rather your consideration can be different from SDV. And there has to be some threshold. There will be some areas where stamp duty value is around, let's say, 110 lakhs, whereas consideration may be thereabouts 105, 106. So just because SDV is slightly more, should I take the SDV value is the question. So they went to the government and said, sir, some threshold you give, some leeway, some breathing space. They came out with the breathing space, and the breathing space was what? This dialogue. If SDB is greater than 110% of consideration, only then SDB will be the FEOC. For example, if the consideration is 100 lakhs, SDB if it is 110 lakhs, no problem. SDB is 109 lakhs, no problem. SDB is 108 lakhs, no problem. So I will take the FEOC only to be the consideration. If SDB is less than or equal to 110% of the consideration, then consideration is equal to FEOC. But if SDB happens to be more than 110% of the consideration, SDB is 120 lakhs, consideration is 100 lakhs, 110% of consideration is 110 lakhs. Is 120 more than 110? Yes. If SDB is more than 110% of consideration, then SDB is equal to FEOC. So if SDB is less than or equal to 110% of consideration, then consideration is equal to FEOC. If SDB is greater than 110% of consideration, then SDB is equal to FEOC. 10% threshold is given by the government. Hope you got it. Now this 10% threshold, is it for capital asset or is it for stock in trade also? For example, I am a builder. I have lot of stock in trade. SDB and I'm selling it for some amount, but SDB is some other amount. 110% is applicable for a builder or 110% is applicable only for you and me who have homes as capital asset. That is another question. So interesting to note that this 110% will apply to land and building or both held as a capital asset under section 50C and held as stock in trade under section 43CA. This 110% concept will apply both for land and building and both for stock in trade. Capital asset 50C, stock in trade 43CA. Hope you got this point. So it's not just for capital asset, it's also for stock in trade. So 50C, the same concept is applicable both for FPOC, for both for what do you say, capital gain as well as the counterpart, same section counterpart for PGBP is 43CA, guys, 43CA. Right, so whenever they ask anything, first I should see consideration. Let's say they have given consideration everywhere, then SDB, they would have given SDB, then I should do 110% of consideration. 10 lakh will become 11 lakh, 10 lakh will become 11 lakh, 50 lakh will become 55 lakh, 10 lakh will become 11 lakh. Then I should see step number 4, that is comparison between step 2 and step 3. And then calculate the FPOC. If step 2 is less than or equal to step 3, then step 2 only will be the, if step 2 is less than step 3, then step 1 will be the FPOC. 10 lakh 70 is less than 11 lakh, so 10 lakh is the consideration. 11 lakh, so 10 lakh is the consideration. 57 lakh is greater than 55 lakh, guys, so 57 lakh will be the FPOC. 11 lakh 40 and 11 lakh, obviously 11 lakh 40. So guys, one more interesting point. So my auntie, distant auntie, has a property in Madikeri. The cost of acquisition of that house was, let's say, around 2 crore. The stamp duty value as of now is 11 crore. I'm not joking. She bought many years ago. But the fair market value is just where people are wanting to buy. That is basically consideration. People are ready to pay is 5 crore. You may ask why. It is very much possible. Because in that Madikeri, her house is here. Lot of mountains are there everywhere. And in the recent past, there have been landslides. Though it will not impact her house, but still there is danger of the entire house getting destroyed. So even though in the land records and in the sub-registrar's office it is actually running at 11 CR, people are ready to pay only 5 crore for that. Now let us say she actually sells it at 5 crore. For income tax purposes, what should she take? SDV, is it greater than 110% of consideration? 100% yes. And 110% of 5 crore is 5.5 crore. Is 11 crore more than 5.5 crore? 100% yes. Yes or no? Is 11 crore more than 5 crore? 100% yes. Correct? What to do? So in these scenarios, I will go to whom? I will apply to the assessing officer to go to the valuation officer. I say, sir, see, general rule, I agree, sir, but here, genuinely, sir, it cannot be 11 crore, I cannot, nobody will pay 11 crore. Please see how it is. Probably you need to see what it is. Please calculate the FMV. So I'll go to whom? The valuation officer to compute the FMV. Because it may not be 5 crore, but I know it cannot be 11 crore. Generally, consideration and FMV will be the same, no? Which fool will give anything less than the market rate? No fool will give. So when I'm getting consideration 5 crore, and but STV, some old land record is 11 crore writing, because not old land record, current record only, but they'll not consider those factors only. You only tell me, guys. In a very nice area, the rate is 1 crore. But if that same in that very nice area, one new cemetery has come up. Smashana. Smashana is there next to the house. Cemetery. Will that be 1 crore? Will anybody be willing to pay 1 crore for that? No. It will be definitely less. Like this only here, practical case. So I'll go to the valuation officer and say, sir, please, you only decide what is the FMV. If the valuation officer is one other mental guy, he will say, no, this 11 crore also is wrong. FMB is actually not 5 crore. FMB is 12 crore. Mental guy, what to do then? Or he may say, no, FMB is actually 4 crore. Or he may say, no, FMB is 8 crore. Three possibilities only is possible. One is less than FMB. One he can go more than SDV only. And one more he can come in between. Guys, if SDV as per the record is 11 CR and this stupid fellow is charging 12 crore, Nirmala aunty says, no, he's one mental fellow, you ignore. This is only one mental rate. This is more mental rate. Ignore the more mental rates. Second, if they are saying 4 crore, Nirmala aunty will throw that person out. He will say, people are ready to pay 5 crore. You are giving 4 crore as FMV. Are you mad? Transfer. Gone. The only logical solution is if the valuation officer comes to 8 CR. The valuation officer comes to 8 CR. Then the lawmaker is telling in these circumstances where you have approached that guy and is telling no, it is not 11 crore, it is 8 crore. Basically, this FME only is 8 crore. So you should take it at 8 crore is telling. Don't take it at 5 crore, take it at 8 crore and close it. That makes sense. That makes sense. Take it at 8 crore. Right? Don't take 11 crore, Baba. Fine. SDB only, this entire thing, you make it at 8 crore now. So pay tax on 8 crore. So what will be the FVOC? FVOC will be the valuation officer's route of 8 crore. Valuation officer's road of 8 crore will come only when you go in between your FMV and the SDV. Valuation officer I should listen to only if you go in between FMV and SDV. Nothing more, nothing less. Hope you got this point. Very, very practical. No need to mug up anything. Very practically I'm telling everything. So it's very easy for you to understand. I hope. Yes or no, guys? Mangalore friends. I just love Mangalore, man. I always have very positive vibes when I come to Mangalore. Mangaluru. I like the entire route also. Early, once upon a time, it was very horrible. That Shiradi Ghat and all was very horrible roads. But of late, last couple of times I've come, it's been pretty decent. Because I've spent my childhood there, that is very close to my heart. Right? So write down on MCQ, guys. Write down on MCQ, then you can answer that. Selling price 55 lakh. Selling price 55 lakh. I'll dictate. Selling price 55 lakh. SDV 68 lakh. Selling price 55 lakh. SDV 68 lakh. So obviously, if you do 110%, it's coming up to some 60.5 lakh or something. The AO. The AO computed the FMV as under. 4 different scenarios I'll give. The AO computed the FMV as under. Means I went to the AO and said, please go to the compute the FMV. So this is not correct. I don't think it is 68 lakhs is what you are telling. So you are going and telling, sir, 55 lakhs I'm ready to pay, sir. I'm ready to receive, sir. But you only tell me, sir, what is the FMV? So FMV as under. 4 scenarios. First one, 66 lakh. First one, 66 lakh. Second one, 70 lakh. 70 lakh. Third one, 57 lakh. Third one, 57 lakh. And fourth one, 50 lakh. Fourth one is 50 lakh. Fourth one is 50 lakh. Tell me, guys, what will be the final decided figure? This is what the valuation officer has told. What will be the decided figure? Take 1 minute and tell me the answer. Just 1 minute I'll give you. In each of these things, 4 different scenarios. In 4 different scenarios, what is the answer? See, if it is 66 lakh, that is in between 55 lakh and 68 lakh. So it is 66 lakh means in between the two, no problem. FEOC will be that only. But if I am making it 70 lakh is more than 68 lakh. That is that mental fellow example. 11 crore remit of 12 crore, no, not possible. So even if it is 70 lakh, I will take 68 lakh only. Fourth one you see, 50 lakh. 50 lakh is also in 50 lakh is less than 55 lakh, not acceptable. So that will be taken as 55 lakh only. That will be taken as, selling price will be taken as 55 lakh. It can't be taken less. Fourth one you see, third one example, 57 lakh if it is there, guys. 57 lakh. Will you take 57 lakh or will you take 55 lakh? So guys, suppose I assume my SDV only 57 lakh. That's what they are trying to tell. FMB, SDV, everything 57 lakh they are telling. If they are telling that my SDV only is 57 lakh, 55 lakh plus 10% is what? 60.5 lakh. Correct. So 110% if I take, it is coming up to 60.5 lakh. And assume this will be my SDV now. Isn't it less than or equal to 60.5 lakh? Yes. If it is less than or equal to 60.5 lakh, then my selling price only should be FPOC. So many people write 57 and come. It is wrong. See, if it was 66, think about it. 66, 55 plus here, 66, first question, 66. 66 means 55 plus 5.5, 60.5 lakh. Isn't 66 lakh more than 60.5 lakh? Yes, so take 66 lakh. But if it is 57 now, 55 plus 5.5, 60.5. Is it 57 less than 60.5? Yes. So you should not take 57. You should take 55. Very important. This is a mixture of that 110%. That is the main rule. 110% cannot change. 110% rule cannot change. This is just an additional thing. That's all. That 110% has to be taken always. Got it? One 10% has to be taken always. Before that, I told you one thing. SDV of which day should I take? Agreement for sale date or registration date? SDV as per agreement for sale is 50 lakh. On registration date is 60 lakh. But here I have paid 1 lakh advance through bank account. I should take this or this. Obviously, for my benefit, SDV I should take less only. So if I paid advance money in bank account, I will always take this only, no change. Registration day 60 lakh, that will not be taken. 50 lakh only will be taken. Moving on, guys. Moving on from all these things, we still have to do the IFOS part of it, income from other source part of it. What is that? I told you about my auntie thing, right? You see, I told you about my aunt's case. SDV was 11 crore. Consideration that she was getting was 5 crore. My auntie is the seller. Some other fellow is the buyer. My auntie has to take what value? 5 crore or 11 crore? Unfortunately, 11 crore, because SDV is greater than 110% of consideration. Consideration is 5 crore. 110% is 5.5 crore. Is 11 crore more than 5.5 crore? Yes. Is 11 crore more than 5.5 crore? Yes, it is. So the seller, my auntie, has to take the full value of consideration as 11 crore. She actually got in her bank account only 5 crore, but for tax purposes, she has to show 11 crore. Arun Jaitley ji did not live here only. Telling buyer, who's the recipient, he is getting a 11 crore property for peanut 5 crore. 6 crore benefit he has got. Benefit he has got. So he has to pay tax on 6 crore. Deadly. My auntie is also paying extra tax on extra 6 crore. Buyer also is paying under income from other sources gift taxation 56 to 10. Gift taxation extra 6 crore. Isn't it double taxation? Yes. Gift taxation always leads to double taxation. That is IFOS. That we'll see later. Income from other sources. And on which day will I take the, what do you say, stamp duty value? It is the day when I have paid the advance. That day only I will take the stamp duty value. Next, second point. Any advance money if I forfeit, what will happen? Advance money if I forfeit. Means what, guys? What do you mean by advance money forfeited? Mr. RCB, he had acquired a house in 2002-2003 for 70 lakh rupees. He wants to sell it to Mr. CSK in 2007-2008. Mr. CSK has given him an advance of 15 lakh. Selling price decided was 1 crore. Mr. CSK backed out of the deal last minute. This 15 lakh was a non-refundable advance. So Mr. RCB swallowed it. The question here is that taxable 15 lakh? Will it be taxable or will it be reduced from the 70 lakh? Will this be taxable or will it be reduced from the 70 lakh is the question. And later CSK will not buy. RCB wants to forfeit. Is it possible? RCB gained 15 lakh. So the provision here is before 1/4/2014. It is a very stupid provision. You had to reduce it from the cost of acquisition. Imagine, guys, 20 years ago I bought a house. 20 years ago I bought a house for 10 lakh. 40 years ago it was 10 lakh. Now in the year 2020, 11 lakh rupees got forfeited. Or let's say in 2010, I was selling it for 1 crore. 11 lakh got forfeited. So that is for me. They are telling you should reduce from the cost of acquisition. So it will be 10 lakh minus 11 lakh. Cost will be minus 1 lakh. Very stupid provision. But what is relevant today is after 1/4/2014. This one. They say that extra money that you have earned will be what? 5629. Advance money forfeited, income from other sources. (5629) IFOS. Advance may get forfeited. Year of forfeiture. So before 1/4/2014 it's different. After 1/4/2014, this before one you leave, no problem. After 1/4/2014, what will you do? It will be IFOS. Advance money forfeited will be income from other sources. You need to pay tax on that because an extra benefit that you have got, no? It's income from other sources. One more interesting thing. Miss Sheila. Section 27, deemed owner. How? Miss Sheila, in the year 2000 to 2003, 1 crore she has bought a house. She is now about to sell it to Mr. Atesh. He did not purchase it. 10 lakh was forfeited. 10 lakh was forfeited. Right? So 2000 to 2003, 1 crore was the house. Sells it to Mr. Atesh. 10 lakh got forfeited in the year 2000 to 2003. Okay. When you forfeit it, it was way before 2014, so leave it. Now, Sheila gifts the entire house to Mr. Kaushik. Gifts. Gift is not a transfer. Now, this guy, Kaushik, in a gift taxation, gift is not a transfer. In capital gain, everything will come from the previous owner. Cost of acquisition will come from previous owner. Everything will come from previous owner. Period of holding will from previous owner. Everything from previous owner. Cost of improvement also incurred by previous owner you can take, no problem. It's as if Sita never existed. Now Kaushik wants to sell it to somebody else, Mr. Abu, 4 crore. All that is okay. This 10 lakh which was forfeited, will it be subtracted from the cost of acquisition? What did I tell you? Period of holding will come from the previous owner. Cost will come from the previous owner. Cost of improvement will come from the previous owner. Everything from the previous owner. What about forfeited amount? 10 lakh which was forfeited. Will that also be taken into account is the question. Very, very stupid provision. Advance money forfeited by previous owner has to be ignored. Illogical point. Any advance money, if the old person has taken it, no, Miss Sheila. It has to be ignored in the calculation. When everything else you are taxing, everything else is coming from previous owner, why not this? We don't know. So it is absurd for sure. Check out point number 3. Right. So in the previous session, we had discussed the last part was treatment of advance money forfeited under section 51. But now we need to study transactions which are not regarded as transfer, section 47. What are the transactions which are not regarded as transferred? Means what? These are the items where the transfer is considered to be exempt. In the sense, it's not even transfer. Forget about being exempt. Exempt is something which is applicable, but then I'll say it is not applicable. But when I say it is not regarded as transfer only, correct? So when I say exempt, it means it is applicable, but later I'll make it not applicable. But when I don't consider it to be transfer only, then it is very interesting. When I don't consider things to be transfer, then what comes would be the fact that even if you transfer that particular asset, then lawmaker is telling, no, it is not a transfer. So you are telling, no, I'm transferring. She's like, no, it is not a transfer. So it's a crazy thing. So there are certain things which are not considered to be transfer, which means they are exempt. First one, Hindu undivided family is transferring a family asset to the members. So if a Hindu undivided family is transferring on partition of the Hindu undivided family, is transferring to its members, then it is not transfer. It is not considered to be transfer. So you see, that is one. Transfer of a capital asset on total or partial partition of HF is not a transfer. Next, transfer through gift, will or inheritance. Gift, will or inheritance. So guys, if your father gifts it to a son, if father gives it to a daughter, mother gives it to a son, mother gives her property to the daughter, it is not a transfer. And either gifting or not just relative. I gift something, a property to my best friend, assume. Is it a transfer? No. So any gift, whether between relatives, between non-relatives, whatever the case may be, is not a transfer. Similarly, will. Through a will, if I write something and give off to somebody else after my death, it should reach somebody else, that is also not a transfer. Inheritance is also not a transfer. What is inheritance? Obviously, if the parents, whatever property they have, they pass it on to their children, that is called inheritance. So, gift, will, inheritance, all the three things is not a transfer. Okay. Now, interestingly, if a company was gifting something to one more company, if a company was gifting to some individual, that was also not a transfer. But was the intention of this section only to cover individuals, or was it to cover all types of gifts? That was what was Nirmala madam was discussing, that what type of gift is covered in this. Is it from one individual to another individual, or from one company to other companies also should I cover it? Was the question that they were asking. So guys, check this. There was an amendment here. Any transfer of a capital asset only by an individual or HF only, they are covered, guys. Important amendment, which means if a company is gifting it to an individual, if a partnership firm is gifting to an individual, all these things will still be considered as transfer. That's the rationale in order to eliminate the avoidance of capital gains. Very, very interesting amendment, very important amendment also. Only individual or Hindu undivided family gifting to anybody else under a gift or will or irrevocable trust. Irrevocable trust means it is sent to a trust for the benefit of you. Basically, I want to look after you. I'll open a trust, and everything I will start giving to the trust. And once you attain a certain age, you will be getting that money. And can I cancel that particular trust? No. Can I cancel that particular gift? No. Why? It is called as irrevocable. Revoke means cancel. Irrevoke means cannot cancel. Irrevocable trust. Got it? Yeah, that is what the deal is. So basically, gift, will or inheritance, they have given for that. But what about ESOP? I have got employee stock option plan in my company because I worked really well. And from there, what did I do? I got employee stock option plan because I worked really well. No problem. And now can I gift that to somebody else? Unfortunately, there is no exemption for that. So if you see here, this exemption shall not apply to a transfer under a gift or irrevocable trust of a capital asset being shares, debentures or warrants allotted by a company directly or indirectly under ESOP. Right? So I have got the ESOP. I am gifting it to my friend. I am gifting that ESOP to my wife. All these things, unfortunately, is still a transfer because ESOP only is a transfer. Because, I mean, ideally they should have not done it, but predominantly from before only the same concept is there. So it is also a transfer. Then, if I sell any work of art, etc., all these things will be a transfer. In case of gift case, cost of acquisition will be the cost of the previous owner, cost of improvement also will come from the previous person, period of holding also will come from the previous person, indexation also will come from the previous person, all those things. Indexation's main case law, very landmark judgment was Manjula Jesha. Manjula Jesha was the landmark case law which spoke about indexation, whether you will get indexation or not. That is the thing. Then, what about transfer between a holding company and a subsidiary company? That is that a transfer? No. For example, Lipton Incorporated Germany had a 100% subsidiary Lipton India. Lipton India. Now Unilever UK actually took over Lipton Incorporated. So they fully took over the holding company, because of which the subsidiary company also had to sell their shares to the Unilever. So they sold it at 40 rupees per share. They sold it at 40 rupees per share. Sorry, 400 rupees per share. Correct? And what was the face value? 10 rupees. But they sold it for 400 rupees per share. The gain here actually is how much? 390 rupees. Face value is 10 rupees. What is the selling price? 400 rupees. What is the gain? 390 rupees. Is that 390 rupees also taxable? No, because this is the what? Holding company transferring to 100% subsidiary Indian company. Similarly, 100% subsidiary Indian company transferring any capital asset to the holding company. It is not a transfer. It is not a transfer. So holding subsidiary relationship also is covered here. It would not be amounting to a transfer. It would not be amounting to any transfer as such. Then, advance forfeited we have already seen, guys. Advance forfeited should be taken into account in another way. Yes, that we have seen already. No problem. Then of course, an amalgamating company also, if they are transferring a capital asset to an amalgamated Indian company. Amalgamating company, if they are transferring a capital asset to a amalgamated Indian company, then also it is not a transfer. So for example, Sheela Limited and Shriram Limited merge to form Shri Shri Limited. This is amalgamated Indian company. Anything for that matter. Reliance takes over a company called Tesseract. Veranda Learning takes over JK Shah. All these things, absorption, amalgamation, whatever the case may be. Amalgamating company to the amalgamated company, whatever the case may be. No problem. Whatever the case may be, no problem. Absorption is equal to amalgamation, and whatever the case may be, is it transfer? No. So under amalgamating company, you can definitely do this, absolutely no issues. Similarly, demerger. IBM USA got demerged from, which had a hardware and software division, got demerged. So the software division went to Sigma Incorporated, hardware division went to IBM India. What were the resulting companies? Sigma Incorporated and IBM India. Right? So IBM USA demerged company, right? Hardware and software both were there, and the hardware got shifted to IBM India, software got shifted to Sigma Incorporated in UK. Is this demerged company, resulting company basically, is this transfer? Capital assets got transferred, obviously. All the assets were shared between the two. Now, is this resulting company, will this be taxable or not? In the sense, will the entire assets being transferred, is it a transfer or not a transfer? That is also not a transfer. What about this? Conversions of bond, debentures, deposit certificate to shares or debentures of that company. So you own debentures of Reliance, and in that there is a clause. After 2 years, those debentures will be converted to equity shares, convertible bonds, convertible debentures. So these bonds or debentures are converted to equity shares. Is that a transfer? No. So basically, 10,000 debentures are at 10 rupees is converted to what? 2 debentures is to 1 equity share. So those debentures are converted to equity share. It is not a transfer. It is not a transfer. Similarly, if debentures are converted to debentures only, 10% debentures are converted to 12.5% debentures. 10% debentures are converted to 12.5% debentures. Is it a transfer? No. It is also not a transfer. So in this, interestingly, think about one more example. I have 10% debentures in Tata Motors. I have 10% debentures in Tata Motors. Now it is getting converted to 12% debentures of TCS, Tata Consultancy Services. I have 10% debentures of Tata Motors. It is being converted to 10% or 12% debentures of Tata Consultancy Services. Is that transfer? Answer is yes, guys. That is a transfer. Why? Because the law is very clear. Conversion of bonds, debentures, deposit certificates into shares, debentures of that company only. Not any other company. Only that company. Not any other company. I hope you understood. Only that company. Understood? So debentures at 10% is shifted to debentures of 12.5%. Only that company is the question, not any other company. Hope you got it, guys. Similarly, now if you see here, bonds, debentures, deposit certificates into shares, debentures of that company. What about preference shares? Preference shares were not covered. So hence, preference shares is converted to equity shares of that company. That is also taken into account. Preference shares is converted to equity shares of that company. That also is not a transfer. Then sovereign gold bonds redeemed by issued by RBI, individual SSE. So if there is any sovereign gold bond which is redeemed, so there is something called sovereign gold bond which RBI is issuing. So you can invest in that, and when they give you a redemption, when you are giving your redemption only for individual SSE, it is not a transfer. For everybody else, if a company buys it, it will be a transfer. So those are the some of the things. Then see all these things. Amalgamation of companies, I discussed demerger, debentures, bonds, SDB, all that is there. I will come to this point in a while. This point I have not yet explained. I'll come to that. So this also we have seen actually. Holding and subsidiary company, basically the parent company should have 100% share capital and the subsidiary company should be an Indian company. Similarly, if subsidiary company is transferring to holding company, the whole of the share capital of subsidiary company should be held by the holding company, and the holding company should be an Indian company. Holding company should be an Indian company. So section 47 shall not apply. The subsidiary company transfers the capital asset to the holding company or stock in trade. So as per section 47A1, where at any time before the expiry of 8 years from the date of transfer of capital asset, if the capital asset is converted into stock in trade. So guys, basically holding company transfers to subsidiary company. Holding company is holding it as a capital asset. Subsidiary company also should hold it as a capital asset. What they were doing, they were accepting it as capital asset, then suddenly slowly shifting it to stock in trade. Cheating only. I am telling you this transfer, when I am holding company is making a transfer to subsidiary company, that is not a transfer. Okay. Then what happened? Holding company giving to subsidiary company and then suddenly converting it to stock in trade. So where at any time before the expiry of period of 8 years, this should be held on for 8 years. If you are accepting it as capital asset, it should be there for 8 years from the date of transfer. Such capital asset is converted by transferee company into stock in trade of its business. Or the holding or its nominee cease to hold the entire share capital of the subsidiary. Means what? I now transfer to you 100% shareholding, I'll transfer. 100% shareholding I have. So I transfer some capital asset to you. Tomorrow I will divest. Means what? I am no longer holding 100% in you. These two things are cheating things. So what are they saying? If holding company transfers an asset to a subsidiary company, 100% subsidiary company, that should be kept as a capital asset for 8 years. If a holding company is transferring a capital asset to a 100% subsidiary, 100% subsidiary also should take it as a capital asset. They should not convert it to stock in trade, and this should happen for 8 years. If you don't do it, then whatever exemption you got, that will be withdrawn. As simple as that. Secondly, if a holding company has invested in 100% subsidiary and it has transferred a capital asset, okay, no problem. They have held it as capital asset only. They have not converted to stock in trade. That's okay. But this 100% shareholding, if it reduces any day to 99% also, then I have not, for how many years? 8 years again. Then also, whatever exemption you have got here will be withdrawn. Simple as that. No mercy. Whatever exemption you got will be withdrawn. Absolutely no mercy. So you see, then the amount of capital gains exempted earlier shall be chargeable to tax in the hands of the transferor company in the year of transfer of such capital asset. If the transferee company subsequently sells the asset after satisfying the conditions of 47A, cost of acquisition to the transferor company shall be adopted as cost of acquisition to the transferee company. That's all. If I follow 8 years concept, I provide all 8 years I will do, then it is be like a gift. Cost of acquisition of me will be, for me, will be whatever cost coming from the previous owner. If the asset is sold by the transfer company after attracting the provisions of section 47A, means what? You break the rule. Then cost of acquisition shall be the actual cost incurred by the transferee company to acquire the asset from the transferor company. So in this example, if holding company has transferred the capital asset to it at 30 crore, this entire 30 crore is exempt. And the holding company had bought the asset for 20 crore. So when this, after 8 years, when the subsidiary company wants to sell something, what will be the cost of acquisition? Cost to previous owner, 20 crore. But if you break the rule within 8 years only, if you do the need, if you break the rule within 8 years, then they are saying this 20 crore is immaterial. I should take what? 30 crore as the cost of acquisition. Whatever I acquired for, that will be my cost of acquisition, no choice. And I will do a capital gain also of 30 minus 20, no mercy. 30 minus 20 on extra 10 I will pay capital gain, and cost I will not take 20 anymore, cost I will take 30. No questions asked. Because it is not a transfer anymore. It is not a transfer anymore. So regarding that, there is an example here which you can check out when I'll pause it. One example I will, you can read here. All the three are different examples to clarify the same. So one example we can do probably. Remaining you can see. You see, withdrawal of exemptions. Panipuri Limited Holding Company and Sevpuri Limited is a subsidiary company. Building cost of 10 lakh purchased in the year 1-2. Capital asset transferred on 22/4/2020 for 50 lakhs. Case number 1. Building is sold by Panipuri Limited to Sevpuri Limited on 22/4/2020. Sevpuri Limited sold the asset on 27/8/22 for 85 lakhs. In this case, there is no violation of section 47A because building was not converted to stock in trade. Building was not converted to stock in trade, and the relationship between holding and subsidiary also does not cease to exist for 8 years. When will that come? Only if it ceases to exist. Otherwise, no problem. Capital gain will be normal. Cost will be to the previous owner. Period of holding also previous owner. But if the conditions are violated, then cost will vary. If the conditions are violated here, then 50 minus 10 on 40, capital gain has to be paid. Capital gain has to be paid by whom? By Panipuri Limited. And Sevpuri Limited obviously has to take the cost of acquisition as 50. No mercy. So also to ensure that more and more NRIs buy and sell shares in India, there was one more thing. You see, one NRI outside India is selling, what do you say, to one more NRI, non-resident. It need not be NRI, just non-resident. Basically, to ensure that more and more people invest in the shares in India, there is something called as Gift City in Gujarat. It is a international financial services center, and that has its own stock market whereby shares are traded. So any non-resident can come and buy shares there. And if he is now transferring the shares to somebody else, what is the benefit for him? Capital gain will apply now because everything is happening in India. But government has given them a benefit. You see, transfer of a capital asset made outside India by one non-resident to another non-resident in the nature of only two things. Rupee denominated bond of Indian company. It is denominated in Indian rupee, but when you pay US dollars, it will add to the what do you say, dollars. That is the foreign exchange reserves in our country. So to support them, I am saying if you invest in rupee denominated bonds, or if the non-resident invests in what? Government security, it shall not be regarded as transfer. It will not be regarded as transfer. So rupee denominated bond of an Indian company, then government security, it will not be regarded as what? Transfer. Conversion of preference shares into equity shares of that company is not regarded as transfer. That also I do. Because here if you see, bonds and debentures were there, preference shares were not covered, that's the reason why. This C you can ignore, no problem. Partnership form, this is separate. This we'll see later. Okay guys, next. Till G you will have to study, but before that we'll finish off the G till G. Reverse mortgage. What is the reverse mortgage scheme? Very, very interesting. What is the reverse mortgage scheme? Excellent. Very, very interesting. So basically, government realized that many people were dumping their parents and going abroad and not coming back. They were coming back only after the parents' death to claim the property. This was an analysis made by P. Chidambaram. So he introduced a concept called reverse mortgage. Under reverse mortgage, and they had no obviously money also during their retirement. So what they said, do you have a house? Yes. So bank will come and take over the house. Means the property papers etc. will be in the bank's name. No problem. In a mortgage, what do you say? You will have to pay EMI. Bank will give you a loan, you have to pay EMI. But in reverse mortgage, bank will just hold the property papers and there will be one Tata Aji. Bank will give EMI to Tata Aji. Deadly. It's like bank has taken the loan of the property. It's like you have loaned the property to the bank and bank is giving you EMI. First one lump sum amount they'll give and then they'll give you EMI. Imagine. Till when will they give you EMI? 20 years or till your death? Deadly. 20 years or till your death they will give you EMI. And is this a transfer? When you hand over the property to the bank, is this a transfer? No. Then when will it be transfer? After 20 years. You still don't die. Now when you have to take the property back, you can pay the money and take it back. Or you can tell the bank, sir, you sell the house, sir. You recover the money, sir. Give me the rest of the money. No problem. You can do either of the ways. Or if this person dies, son is coming. Son or daughter are coming. They want the property. Then the bank says, pay money and take the property back. As simple as that. So that is the scheme. 20 years from the date of signing the agreement and the approved loan lending institution, if it is directly disbursed. If you want it like a lump sum, or if you want periodic payments like annuity, then until the lifetime of the borrower, there is no tax. Maximum period of loan is a lifetime, no tax. So then when will you pay? When is it capital gain? When you want to transfer it back, then only it is capital gain. Hope you understood, my dear friends. This part we will see later because this is a different concept. Proprietary concern, all those things. All these things are later. Business trust, you will see in business trust. All that is fine. Good. Bonus shares and right shares, we will have to see. So, conversion of proprietary concern into company also, what does it say? That when there is a succession, when a sole proprietary concern is succeeded by a, company, it is taken over by a company or it's converted to a company, all the assets and liabilities must be transferred. And the sole proprietor should not receive any consideration other than allotment of shares. So, sole proprietor, when it's transferred to company, he should get shares alone, nothing else. Some conditions are there. And the aggregate of shareholding of the sole proprietor should not fall below 50% for a period of 5 years. He shouldn't convert to company and then run away. Then that is not the thing. These are some of the conditions. You see, in 47A, it was 8 years. So, here in 4714, it is 5 years. That's all. Similar, here also, private company into unlisted company, private company or unlisted company into LLP. Here also same thing. All the assets and liabilities must be transferred. All the shareholders of the company immediately before the conversion should become the partners of the LLP after conversion. And whatever the shareholders should not get any other benefit other than the share in the profit and contribution of LLP. Same. And that aggregate profit sharing ratio of all the shareholders should not fall below 50%. It should be maintained for 5 years. And there's one more condition. The total sales, gross turnover, etc. should not exceed 60 lakhs in any of the 3 preceding previous years in which the conversion took place. What they're trying to tell is you cannot convert a very huge company into an LLP. If that be the case, you will not get any exemption. So it should be just what? Overall sales turnover should not exceed 60 lakhs. That's all. Peanut amount, small amount. And the total value of the assets of appearing in the books of assets of the company should not exceed 5 CR is what they are trying to tell in any of the 3 preceding previous years. Partners of the LLP should not withdraw the accumulated profits, including reserves, as on the date of conversion, either directly or indirectly, for a period of 3 years from the date of conversion. That's all. You cannot withdraw the profits also for a period of 3 years from the date of conversion, because all these are checks, guys, in place. Why are they putting these checks? Very simple. Because tomorrow I will, what do you say, I will convert it to LLP and then immediately exit. No. And exiting, it's okay. I'll stay back, but I'll keep withdrawing the profits. No. I cannot withdraw anything. Only then all the assets which are transferred, I will not give any capital gain. Otherwise, on every item, I should give capital gain. And if you break these rules, then what will happen? Automatically, if you break these rules, automatically, what will happen? You will have to pay capital gain tax. You have to pay capital gain tax. Very simple. This in business trust, you will understand. Sick industrial company done. Next, capital gain in case of shares, debentures, units, ULIP. Yeah. First and foremost, guys, bonus shares. Guys, whenever I get bonus shares, what will be the cost of acquisition of bonus shares? Nil. There will be no cost only. Right? I'm getting bonus shares, no cost. What will be the cost? Nothing. I'm just investing in it. I'm getting the money back. That's it. There's no cost of acquisition as such. So for bonus shares, there will be no cost of acquisition. Now, bonus shares. There's one interesting thing, that if the bonus is acquired before 1/4/2001, means I'm getting the bonus shares before 1/4/2001. One more is what? Bonus is acquired on or after 1/4/2001. If the bonus is acquired on or after 1/4/2001, then cost of acquisition obviously will be nil. But if the bonus is acquired before 1/4/2001, so it's very, very illogical point. Unfortunately, it is still there. It is what? Cost, which is nil, or FMV as on 1/4/2001, whichever is higher. How does it? Even it is very, very stupid, guys. So if I had received the bonus shares in the year 1999 and today I am selling it, what should be the cost actually? Nil only. But what are they saying? Do you remember in 1/4/2001 I should take that cost or FMV, whichever is higher? Cost will be nil only. No, cost is nil. FMV I should take. Very, very illogical point. Anyway, there will be no bonus shares which you have issued in 1999 which you are selling now, but assume it is there. In the question, if they have given, then guys, what should you tell? Cost which is nil or FMV as on 1/4/2001, whichever is high. Absolutely illogical point. Yes or no? Absolutely illogical. No chance that it is logical. But anyway, it is there. Bonus acquired before 1/4/2001, cost nil. FMV as on 1/4/2001, whichever is higher. Period of holding will from the date of allotment to the date of transfer. Bonus acquired on or after 1/4/2001, cost of acquisition will be nil. Then there is one more. On 31st January, something happened that we will see later. Now, right shares, as discussed already. Let us say market price. I told you in 2020 March, Reliance issued right shares. The objective of getting the revenue, right shares, the main objective there was to pay off their liability. They had a lot of loan. They want to pay it off. So that's why they went for this. So market price was 1,600. Rights was 1,300 issue. 300 rupees was discount. So I have an entitlement. Assume me, PJ, has an entitlement to buy 50 shares. I'm entitled to buy 50 shares. Right? Now, two things can happen. I can acquire the right. Correct? If I acquire the right, 50 shares I will buy at what rate? 1,300 rupees. That's the issue price. Yeah, that's all. What is my cost of acquisition? 50 into 1300. And this will period of holding will be from that day, from the date I am getting allotted. I can either acquire the right, that is 50 shares I can buy, or I can renounce the right. I can renounce the right. Renunciation or surrender or relinquishment. I can renounce the right, I can surrender it, I can relinquish it, give up. So what is the amount here? I surrendered. When I surrendered to, let's say I surrendered to Sheila Aunty. Sheila Aunty is a very famous example of mine in CA Inter and CA Foundation. Let me use it in final also. So I'm renouncing the right, surrendering the right, relinquishing the right to whom? To Sheila Aunty. So if I sold that right, for 200 rupees per share, for me, for PJ, what is the thing? I am getting 200 rupees for nothing. So what will be my FVOC? 50 shares I am selling, 50 rights into 200 per share. Cost of acquisition, did I do anything to get the rights? No, I was simply a shareholder. So 50 into 200 minus nil. It is always short term. It is always short term. That happens in the hands of the PJ. It is what? Always short term. In the hands of PJ, it is always short term. On the other hand, on the other hand, for Sheila Aunty, cost of acquisition will be what? For Sheila Aunty, cost of acquisition will be what? Very simple. 1300 she'll have to pay Reliance and 200 rupees she have to pay me. So what is the cost for her? 1500 into 50. But it's still good because otherwise she'll have to pay how much? She'll have to pay 1600, no? She'll have to pay 1600. Instead of that, she's paying only 1500. She's only paying 1500. That is with respect to right shares. That is with respect to right shares. Yes. There is no indexation in case of debentures and bonds. For debentures and bonds, there is no indexation, obviously, because there is no fluctuation. There is no much fluctuation in debentures and bonds, hence there will be no any indexation as such. But there are two exceptions to this, which means in these two exceptions, you will get indexation. In these two exceptions, you will get indexation. One is called as the capital indexed bond, which has been discontinued. One more is called as the sovereign gold bonds. We just discussed it a few minutes ago. Sovereign gold bonds by RBI. So what is not a transfer? Only sovereign gold bonds by RBI. Redemption only for individual is not a transfer. We have just discussed. So if I want to talk about the sovereign gold bonds issued by RBI, if I want to talk about the sovereign gold bonds issued by RBI for an individual and for a other SSC, maturity period for both the cases will be 8 years. Maturity period will be how much, guys? 8 years. So for an individual, if I am redeeming on maturity, I have very clearly told it is not a transfer. For an individual, when I am redeeming it on maturity, it is not a transfer. Hence, there will be no capital gain due to section 47. But if I am redeeming before maturity, then capital gains will apply. Indexation benefit, capital gain will apply. If other SSC is concerned, if it is redeeming on or before maturity, redemption is happening on or before maturity, it is transfer, capital gain also will come, indexation also will come. Very, very simple. Only if it is happening before maturity, then capital gains will apply, indexation benefit also will be given if it is before maturity. Anyway, now indexation also has been removed. After 23rd July, indexation also has been removed. So directly cost, sale minus cost into 12.5%. Next, slump sale, 50B slump sale. But anyway, his right shares are given here. Debentures, bonds given, UTI, yes. Market linked debentures and debt mutual funds, we will see. This is 50 AA. We will do it with the tax rates. You'll understand that when you're doing tax rates. Then we have ULIP. I'll come to this. I'll come to slum sale. Hold on. Let's do ULIP. ULIP. Computation of capital gain on ULIP. Unit linked insurance plan. So guys, there used to be an exemption under 1010D on ULIPs issued on or after 1/2/2021. Amendment came on which 1010D does not apply. Then it will come under capital gain. First of all, it should be issued after 1/2/2021 and exemption under 1010D should not apply. Correct? What is that exemption? Exemption under 1010D does not apply for sum received under ULIP issued on or after Feb 2021 if the amount of premium payable for any of the previous year during the term of such policy exceeds 2,50,000 rupees. So guys, if singly or aggregate, if it exceeds 2,50,000 rupees, you will not get the exemption. And if you do not get the exemption, then it will be liable to capital gains. If you remember, capital gains are only 3 items. Item number 1, transfer of any property. Item number 2, FII, foreign institutional investors investing in the capital asset, in the shares, etc., would be deemed to be capital asset. Item number 3, ULIP. Item number 3 was ULIP. And in point number 1, there were 4 exceptions. All those things we saw. 4 exceptions. Exception number 1 was what? What was exception number 1? Personal effect. Exception number 2. What was exception number 2? Your rural agricultural land, right? Rural agricultural land is not. Then third one, your gold monetization scheme, bonds, all those things. So it would not be a capital asset. It was not a capital. Then we have your personal effect, and personal effect excluded certain things, all those things. But on the other hand, computation of capital gain on ULIP. ULIP issued after 1/2/2021 to which exemption at 1010D will not. When will exemption at 1010D come? Exemption under 1010D does not apply for sum received under ULIP issued on or after February 2021. The amount of premium payable, how much? Exceeds 2,50,000 rupees. Similarly, where a person subscribed more than one ULIP issued on or after February 2021, the aggregate of premium on all such policies exceeds 2,50,000. So, if your premium exceeds 2,50,000 rupees, then that exemption will not apply. Since exemption does not apply, automatically it will be capital gain. Anything that you receive will be a capital gain, no doubt about it. Okay. Screen got stuck. Yeah. Okay. So aggregate first one by one example, guys. Date of issue, you see here. Date of issue 1/4/2012. Annual premium 5 lakh. Sum assured 50 lakh. Consideration received on 1/12/21 60 lakh. In this case, since the policy only was issued before 1/2/21, no problem. In this you see date of issue 1/4/21. Here 1/4/21. Annual premium 2 lakh, 3 lakh. This one is exempt because annual premium does not exceed 2,50,000. This one B. This is not exempt because annual premium exceeds 2,50,000. If the annual premium exceeds 2,50,000, then nothing, there ends the matter. If the annual premium exceeds 2,50,000, there ends the matter. Consideration received under ULIP number A shall be exempt under 1010D since annual premium payable does not exceed 2,50,000. Here, 1,50,000. Is it exceeding 2,50,000? No. But point number C is exceeding 2,50,000 premium. Hence, it is taxable. Example number 5. All were issued 1/4/21. C automatically will not be exempt because it is more than 2,50,000. In this, guys, in this, I can do a combination. If I do 2 plus 1, no, 3 lakh it will be because it is singly or in aggregate. If I do 2 plus 1, it will be 3 lakh. So I can standalone take X or I can take A and B combination. If I take A and B and combination, X will not be exempt. If I take X as a X alone, A and B will not be exempt. So here what should I choose? I should see the consideration. If I choose X to be exempt, no, because the premium is 2 lakh, this anyway is not exempt. This is taxable. Here I can either choose X or I can choose A and B. If I choose X, 25 lakh is what I am getting. If I choose A and B, 30 lakhs is what I am getting. What would be better? If I avail exemption of A and B, then this would be better. Correct? If I choose the option of A and B together, exemption, then the sum assured 30 lakhs, fully exempt. So what would be taxable then? This would be taxable, this would be 34 lakh will be taxable, 25 lakh will be taxable. That's what I need to look at. So this is also very simple. Rule 8AD speaks about calculation of capital gains. You see example. Somnath invested 4 lakh per annum in ULIP of ABC Limited from 1/4/2021 for 10 years. Policy value was 50 lakh rupees. Mr. Somnath received 45 lakhs on 25/9/2026 from the policy. On 31/3/31, he again received 25 lakhs from such policy. In this case, capital gain shall be computed as follows. How? So amount received in 26/27 because 10 years, no? Amount received in 26/27 is how much, guys? 45 lakh. 45 lakh. Plus all the, for the first time including bonus, 45 lakhs is taxable. In that, how much? Aggregate premium paid till date. Guys, what is taxable is not the consideration. In that consideration, it will also include my investment, right? See, 2 lakhs I am always paying every year. Some 10 years I would have paid. 20 lakhs is what I've already paid. For the investment that I've made 20 lakhs, 25 lakhs I'm getting. So what is the taxability? Only that extra 5 lakhs. Taxability is only that additional 5 lakhs. That's all. So here also I have to compute that only. What is the amount received for the first time including bonus? 45 lakhs. Less. What is the aggregate of premium paid till the date of the receipt? 4 lakh into 6. 4 lakh into 6. This is the aggregate premium paid because I paid 4 lakh every year. For how many years I paid? 6 years. So 24 lakh. So what is the long term capital gain? 21 lakh. 45 lakh minus 24 lakh. What is the long-term capital gain that I got, guys? 21 lakh. Now, this is for the amount received in the year 26-27. What are the amount received in the year 30-31? Amount received after receipt in A. He again received 25 lakh from such policy. That I have to add here. Aggregate of premium paid till date of receipt, excluding the premium paid for A. So guys, I have already paid so much. How much have I paid? Till the date of receipt, excluding the premium paid for A. 4 lakh into 4, because 4 more years I had to pay, no? This is till year, it's already calculated. The next 4 years also I paid, no? This one. So what is the long-term capital gain? 9 lakh. So till here I had already calculated, there ends the matter. Next year also I received, no, 25 lakh 4 years later. So from previous year 26-27 to 30-31, 4 years. 27-28, 28-29, 29-30, 30-31, 4 years. So 4 years also I'll be paying premium. So this is the balance. And there will be some other examples. You can go through all these things. You can go through later. These are other examples. Very simple, guys. Very simple. So this is all regarding bonus and other things. So after all this is done, next going on a slump sale. Slump sale 50B. So what is slump sale, guys? Very simple. Slump sale is where I sell an entire undertaking or an entire division. For example, if ITC, Indian Tobacco Company, has many divisions. It has what? Tobacco, FMCG, hotel, stationery, and guys, block of assets in the WDV, no, block of assets. Is it like business wise or for the entire company wise? It is the entire company wise. So for ITC, the plant and machinery of tobacco, FMCG, hotel, stationery, everything will be merged and it will come to the block of assets. Everything will be merged and then it will come to the block of assets. Tobacco, FMCG, hotel, stationery, everything. So if you remember in the actual cost, when we were calculating WDV, when we were calculating the WDV, if you go to that WDV thing, slump sale is what basically? If I sell the stationery division, assume I'll sell the stationery division. So all the assets are in this block of plant and machinery. But if I'm selling the stationery division fully, I'm removing it from there. I'm removing it from that block. So in slump sale, I will not sell the asset. I will sell the division. This entire stationery division only is the asset sold. Which means what all will go? All the assets and liabilities will go from the stationery division to some other company. It is like a demerger only, but not demerger of a company, it's demerger of a unit or a branch. Slump sale, bulk, all the assets, division, segment, everything is transferred to some other division for a lump sum payment. It is governed by 181A of the Companies Act, slump sale. You require a board resolution and a special resolution for the same. 181A. Board resolution and a special resolution you will need for this. So in a slump sale, any segment division undertaking for a lump sum payment, that entire division, stationery only will be removed and it will be sold. So what will be the full value of consideration? Very simple. I have to calculate the FMB as per Rule 11 UAE. An FMB has to be taken. Sometimes it will be given in the exam, sometimes you have to compute. It will only be the FEOC, the FMB. And from that FMB, I have to subtract the transfer expenses. And finally, what I get will be the net consideration. So, stationery division is sold for how much? It is sold at FMB of the business, minus the transfer expenses. Net consideration minus cost of acquisition, that is a net worth of the company, net worth of the division, stationery division. How will I compute the net worth? Very simple. All assets minus liabilities will be the net worth. So will net worth and FEOC be the same? No. FEOC will be what value, perceived value of the entire thing. What would it be? If net worth is 100, I am ready to pay 120 for that. I am ready to pay 150 for it. Premium. 50 is the capital gain. So this FMB is a fair market value minus net worth. Net worth is all the assets minus liabilities. That will be my short-term or long-term capital gain. Some of the assets in the stationery division may have been bought 5 months ago, 4 months ago, 3 months ago. And some of the assets in the stationery division may have been bought 1 year ago, 3 years ago, 4 years ago. I do not care. The period of holding is not the asset wise. Period of holding is the date from which undertaking was started. Assume. Correct? Deadly. Not the assets, undertaking. If the undertaking started 5 years ago, then it is long term. If undertaking started 3 years ago, long term. Undertaking started 7 months ago, short term. If the undertaking started 5 years ago, but all the assets are new, 6 months ago only I bought, still it is long term. I hope you understand. That's the beauty of slum sale. Slum sale does not care about assets. Slum sale cares about the entire undertaking. You need to understand that. So how will I compute the net worth here? Asset, depreciable asset will be as per WDV as per Income Tax Act. Non-depreciable asset will be the book value. Depreciable asset will be WDV as per Income Tax Act. Non-depreciable asset will be the book value. And whatever amount you get, you will subtract the liability, then it will be the net worth. So WDV as per Income Tax Act, non-depreciable asset book value, and whatever you get, less liability, book value again, will be give me my net worth. Will give me my what? Net worth. So depreciable asset, WDV as per Income Tax Act. Non-depreciable asset, book value. Total you will get less liability, book value. Net worth, you will get the same thing. That is simple. That is my slum sale. And in the WDV that you will compute, WDV will be for the entire ITC. You should remove the stationery division from the block. The block of assets, you should remove the stationery division. So if you remember, you come to this, I'll show you. Page 1 point. This is the actual cost we saw. There you go. Page B16. This here. This will be the WDV of the entire ITC. In that I have to remove the stationery division. Where will I remove? Check this here. There you go, see. WDV of assets transferred in slum sale. From the plant and machinery, remove all the Plant and machinery of stationary division. From other thing, remove all that from the other division. That is what it is. Page B60. That is my slump sale. So, determination of fair market value of a section 50B. You see, A will be the book value of all the assets other than jewelry, artistic work, shares, securities, and immovable property. Because for that, it will be market value. Point number B is for these items: jewelry, artistic work, shares, securities, immovable property. I mean, this is only for jewelry. B is for jewelry. Price at which the artistic work is sold in the open market. Market value, open market value, I have to take. C is fair value of the shares and securities. D is the, for immovable property, it is the stamp duty value. L is the book value of all liabilities. So A plus B plus C plus D minus L. A is book value of other assets. B is fair market value of jewelry. C is fair market value of shares. D is stamp duty value of immovable property. L is book value of all liabilities will be my net worth. Will be my, sorry, FMV computation. FMV computation. This is FMV number 1, or I can do FMV number 2, whichever is higher. FMV number 2 will be the value of the monetary consideration that I am receiving as a result of the transfer, or any non-monetary consideration, an open market price as per the registered value. They only would have given. Monetary consideration, non-monetary consideration, open market rate, stamp duty value of the immovable property, everything they will give in the question. You should just add everything. That will only be the FMB. Valuation report they would have given, add everything, that will be in the FMB. Better way would be to FMB 1. They'll only give in the exam. They don't give, ideally they'll give this, guys. Book value of all the assets other than these things. Jewelry separate, other things separate. Separate you have to see. So what should I take? WDV and WDV, depreciable asset will be WDV. Assets specified business under 35 AD, I should always take it as nil because I have already debited everything into the P&L account. Value of self-generated goodwill also is nil. Goodwill, it was always a problem, how much to value, etc. So I told you there was a case in 2021 where they said, I don't know what is goodwill, do not add goodwill only in the asset. You extract from that thing. And all other assets and liabilities, book value. Indexation, obviously, you will not get in slump sale. Anyway, now indexation is fully removed anyway, but indexation will not be allowed. Then a CA report has to be given. You see the example here. Neon Private Limited sold assets and liabilities of its division Pink as a slump sale to Lavender Private Limited for a lump sum consideration of 650 lakh in monetary consideration. Building for 300 lakh, SDV 400 lakh, and a plot of land 250 lakh, SDV 350 lakh. Balance sheet is as follows: share capital, unsecured loans, sundry creditors, liabilities, fixed assets. Land and building revalued. Should I take revalued amount? No. Current asset, bank balance, loans and advances, closing stock. Land and building was purchased in 2008 for 400 lakhs. SDV is 1350 lakh. I should take SDV of immovable property, right? WDV of plant and machinery as per IT Act is 300 lakhs. First one, full value of consideration. What is it? FMB1 or FMB2, whichever is higher. What is FMB1? A. Other assets will be book value. What is other assets here? What will be other assets? It will be plant and machinery. This one, 350. I will take sundry debtors also is other asset, 260. Bank balance is 80, loans and advance 20, closing stock 90. This entire thing I should take 800 lakhs. B, is there any jewelry? No, B is nil. C, is there any shares? Nil. D, land and building I should take at SDV 1350 lakhs. Less book value of liabilities. Unsecured loan 345. They have given here 345, 250. All that I should take 345, 250. FMB1 will be this much 1555. FMB2, monetary consideration received for the entire deal. What is the monetary consideration received for this deal? 650 lakhs is the monetary consideration received. So 650 lakhs here, 650 lakhs. Other things they have not given. And finally H is SDV of the building and land that they have taken. You see, they have taken 650 in monetary consideration, comma, building SDV 400 lakhs, plot of land 350 lakhs. That also I have to add. So 650 plus, sorry, 400 plus 350, 750. 750 plus 650 is 1400 lakhs. What is the full value of consideration? FME1 or FME2, whichever is higher, 1555. Then I will compute the net worth. Net worth. Value of all the assets will be as per Income Tax Act. Revaluation will be ignored. Liabilities, book value. This will be by net worth. So 1555 minus 555. Ultimately, that is what it is. Capital gain on asset when consideration is not determinable. When the consideration is not determinable. Guys, when I'm exchanging the asset, so if I am exchanging one asset, then whatever the asset which is exchanged, if I am exchanging land for shares, I am exchanging land of 1 crore for shares of 1.2 crore, assume. My FPOC will be 1.2 crore. Whatever it is coming in, right, that I should take. Mr. X has exchanged jewelry for shares. Fair market value of jewelry is 14 lakh, and fair market value of shares is 16 lakh. In the hands of Mr. X, FPOC will be 16 lakh, whatever is coming in. In the hands of Mr. Y, whatever he is getting, what is he getting? He is getting jewelry worth 14 lakhs. That is the deal. Okay, that's the deal. All right, guys. So in the this still here we are done. We had finished the ULIP and all those things. Slum sale also we had finished. Sorry. Now moving on. If you check the notes, we have the exemptions, but before that we have something related to capital gains on asset transfer by non-residents. Capital gains on asset transfer by non-residents is something else we have. That also we need to finish. Okay, so non-resident, taking into account the non-resident, what are the things that we have? So some important rules of international taxation, because we have the non-resident here also. So what are the rules? Rule number 1, any person who is a resident or non-resident who initiates a transfer of what assets located in India to any person who is a resident or a non-resident, and that income that you are getting, no, that will be deemed to accrue or arise in India, even if the transfer took place outside India. I repeat again, any person, resident or non-resident, who transfers an asset located in India, asset can be shares, immovable property, debentures, whatever it is, to any person outside India also, or in India, right? But the asset must be located in India. Then the income is what? Deemed to accrue or arise in India. Even if the transfer takes place outside India, it is deemed to accrue or arise in India. Point number 1. Rule number 2. Any shares, debentures, bonds of the company, if they are located at a place where the registered office of the company is situated. Correct? Any shares, debentures, bonds of the company, if they are located at a place where the registered office of the company is situated, then also it is what? Deemed to be asset located in India, because it doesn't matter. This happened, this amendment came during the Vodafone Hutch case, as I told you, because Hutchison SR sold it to Vodafone. Everything happened outside the country, but the shares were of what? Hutchison India, right? So that's why they added this also. Shares, debentures, bonds of the company must be located in India. So even if you do anything all golmaal outside India, if the shares are located in India and that is transferred, that is deemed to accrue or arise in India. Deemed to accrue or arise in India. Rule number one, rule number two. Okay, so with this in mind, for the non-resident, what all is there? What all is there for the non-resident? Yeah. So first of all, for the non-resident, indexation is not applicable. Indexation is not applicable. And what he can do is he can convert everything into US dollars and then take it into account. So the first, apart from the other 47 thing, first, if you see, first proviso to section 48, the entire concept of indexation, etc., will not apply. So what will apply to him is basically the telegraphic transfer, buying and selling, TTB or TTSR, that will apply. So that is one part of the story. Apart from that, these things also will apply. So let's just finish the other areas and then come back to that. So here, 47 10A. So that is for Chidambaram had introduced this. If you are converting any bonds to shares or debentures of any other company, so basically it should be a foreign currency, bond. It should be a foreign currency bond, and everything, whatever you purchase, everything should be in foreign currency, should be a non-resident. So if you are converting it into shares, correct? If you are converting into shares, then 47, then it is, exempt. 47 is what? Exempt transfers. Transfers also, exempt transfers also. Then bonds or GDR, global depository receipts, that is one non-resident giving to another non-resident, we already saw, it is also exempt. Similarly, government security is also exempt. Then that is RDB, that is rupee denominated bonds, which are bought in foreign currency but they are redeemed in Indian currency. There also they are saying it is exempt. Similarly, anything that you do in IFSC, International Financial Services Center, that also will be what? Exempt. So absolutely no problem. All these things will be exempt is what the lawmaker is telling. It's exempt for whom? It is exempt for the shareholder. It is for the exempt for whom? The non-resident people. Because it's fine. There is nothing great for them in that. So that is definitely, I am giving you a benefit for a non-resident is what they have told. So second, apart from that, this first proviso to section 48, that is capital gain in case of shares debentures transferred by non-resident. So for example, let's take an example. US resident, 1 lakh US dollars is having, $1 is equal to 70 rupees. So 70 lakh rupees he has pumped in the country. Then later 10,000 shares he bought with that 70 lakh rupees into 700, shareholder has got it. Then he sold those 10,000 shares. He sold those 10,000 shares at 800 rupees. So 10,000 shares at 700, shareholder sold those 10,000 shares at 880 lakh. So capital gain will be how much? 80 lakh minus 70 lakh, 10 lakh. So at the time of sale, $1 was 85 rupees. At the time of sale, $1 was 85 rupees. So 80 lakh by 85, unfortunately, how much guys? $94,118. So think about the non-resident. Why the hell will he invest in India? Because you see, outflow investment was $1 lakh. Return on my capital is $94,118. And what is the loss? $5,882 I lost because of exchange difference. Point number one. Second one, I also had to pay tax on 10 lakh. Tax also I had to pay on 10 lakh. Crazy. So first of all, there was a loss of 5882. And secondly, there is a tax on 10 lakh. There is a tax on 10 lakh. Thank you. Thanks. There is a tax on 10 lakh. And then what? There is a loss of how much? $5,882. So then why will I invest? That's why first proviso came. First proviso came, whereby they said, do one thing, convert everything to US dollars at the beginning itself. So full value of consideration, first one is average rate on the date of transfer you take, TTBR and TTSR. Telegraphic transfer buying rate plus telegraphic transfer selling rate divided by 2. So first you will take full value of consideration, average. Then transfer expense also you do the average. And then we will do the cost of acquisition, no indexation benefit, because I'm doing the average. This is nothing but the market rate, buying rate and selling rate of the bank. So you're doing the average only, which includes the indexation already. So there is no indexation benefit to be given. And finally, whatever you get, you convert it into telegraphic transfer buying rate. Telegraphic transfer buying rate is the rate at which the bank buys the dollars. Telegraphic transfer selling rate is the rate at which the bank sells the dollars. So if you do it like that, if you do the average like this, then what will happen is these loss etc. can be avoided because of the exchange fluctuation. Unfortunately, I was undergoing a lot of loss and then I have to pay tax on the difference also, 70 minus 10, because I converted everything. Now no conversion needed, directly do it in dollars, which will include all the losses, profits, etc. So telegraphic transfer buying rate, telegraphic transfer selling rate divided by 2, you will get the dollars. So that average rate final thing, no, when you are calculating the short term or long term gain in foreign currency, convert it into INR. Convert it into INR. This will be what? Telegraphic transfer buying rate on the date of transfer. So short term or long term in foreign currency. So TTBR on the date of transfer. So average rate is what? TTBR plus TTSR divided by 2. So that will be the dollar. So that should be taken as the dollar. Very, very simple. So everything should be done as per average rate except the final one, short term or long term. That has to be done as per what rate? That has to be done as per what rate? That has to be done as per TTBR on the date of the transfer. So with this, what I am doing is I am essentially reducing my burden. This is one benefit given. Apart from that, I already told you section 47, there were so many discounts that are given. Even with respect to GDR, so many things are given. So any bonds, etc., everything I will give you a benefit. So in this case, first proviso to section 48 says indexation will not be allowed. Indexation will not be allowed. Now this is the scene, guys. So very simple. Now guys, moving on to an interesting area, exemptions. Exemptions under 54 to 54F. This generally they will ask you in the MCQs, or they will also they will give it to you where it is. They'll give it in the, what do you say, questions as adjustments. So either adjustments will come or MCQ. The other thing will come. That is your in MCQs it will come. So what is it? Very simple. What are the who's the eligible SSE here? An individual. So section 54 is exemption for residential house property. So who's the eligible SSE? Individual. What is he transferring? Residential house property. Is it short term or long term? Long term. He is selling one residential house and buying another residential house. So then in that case, when should he buy? So you see this chart, this other part you can see later, but see the chart first. Mr. Raj, individual or HF, selling residential house property. And he should purchase a new house property either 1 year before or 2 years after he sells. So he's selling a house property. 1 year before he actually sells it or 2 years after he sells it, he has to buy one more house property, or he should construct another house property 3 years after this entire thing. 3 years after selling a residential house property. And the proceeds of that entire capital gain, he will invest it in the residential house property, or it will deposit. If he cannot, use the proceeds in another residential house property, he will deposit it in an account called capital gain account scheme. Capital gain account scheme. So I repeat, Mr. Raj, who is an individual, he will sell a residential house property and he should buy another house property 1 year before or 2 years after he does that, or he should construct another house property 3 years after selling the house property, and then he should invest it in another residential house property, and whatever it is, he should deposit in one more thing called capital gain account scheme to be utilized properly. And this entire thing, will be exempt. That cost of new asset or the deposit amount or the cost of the entire capital gain will be exempt if it does so. This new property has to lock in for minimum 3 years. If it doesn't lock in, if he sells off the property, etc., then it will, whatever capital gain you have claimed before will now be not allowed, as simple as that. And similarly, this capital gain account scheme also, you should transfer that amount to that particular account before due date of filing the return. Before your due date of filing the return, it should be done. Now, one more thing, one amendment had come that if can you sell one house and buy two homes? Answer is yes. A one time in your entire life, one time benefit will be given if the total capital gain does not exceed 2 CR. I repeat, total capital gain should not exceed 2 crore. Then the SSE may at his option purchase or construct two residential houses in India. Purchase or construct two residential houses in India instead of one. Further, such benefit shall be available only once in the lifetime of an SC. So, once in a lifetime, I can do it too, provided capital gain does not exceed 2 CR. Capital gain does not exceed 2 CR. Yes. So, what is the maximum deduction that can be claimed, etc.? That also, guys, what people were doing is all big shots. They were selling homes for 20 crore. 30 crore, making capital gain of 15, 20 crore, then utilizing one more thing. Nirmala madam said this section exemption was only for middle class and lower middle class, upper middle class. It is not for the rich class. So they said, let us limit it. You sell one house for 100 crore, make a capital gain of 80 crore, now invest in one more house for 80 crore, and then you are claiming full 80 crore benefit. I'll be losing 12.5% tax on it. So, in the Finance Act 2023, she made an amendment where she said the maximum deduction that can be claimed by the SSE under Section 44 has been limited to how much? 10 CR. Maximum deduction that can be claimed by the SSE under Section 54 has been limited to 10 CR. Limited to how much? 10 CR. So, that is what the entire deal is. 54B. Later, you can read all these things. I'll just quickly finish off here. 54B, guys. Exemption for urban agricultural land. So, Mr. Raj is selling an urban agricultural land and the proceeds is investing in another urban or rural agricultural land. Selling urban agricultural land, but purchasing urban or rural agricultural land. When can he sell urban agricultural land? 2 years before, after he sells, either with 2 years before he actually selling it or 2 years after, he should buy one more urban or rural agricultural land. Now, he should have used that agricultural land, guys. He should have used that agricultural land. So, guys, I repeat once again, clearly hear me out. I'll repeat once again. I told you should purchase another agricultural land 2 years before. That is wrong. My bad. I'll repeat once again. Hear me out. Coolly. Once again. You Control A, Shift Delete whatever I just told. I made a mistake in this 2 years before. I'll repeat it. So now it's clear. Mr. Raj, an individual or HUF, has to sell an urban agricultural land. Okay. If you see this one, no, 54. Here also he should sell a residential house property. When can he buy a new property? He can buy a new property within 2 years after he sells this, or he can construct a new property 3 years after he sells this, or he can also purchase 1 year before only. Next year I'm selling the house. This year only I can buy a new house. No problem. It's not that I should sell it, get the money, from that money buy another thing. No. If I have extra money, I can already purchase. And then when I sell this, when I get that money, I can use it as an exemption. But for agricultural land, it is not like that. I will sell an agricultural land and only within 2 years after selling that land, I can buy one more urban or rural agricultural land. This 2 years is not for purchase. This is the mistake I did while I was talking. In the flow, it came up. I'm sorry. This 2 years is what? An SSE, that is individual or HF, SSE and his parent should have used this asset. Must have used this asset for how much? 2 years. Minimum 2 years he should have used it for. Only then this section comes. And mind you here, this section is for both short-term and long-term capital gain. Both short-term and long-term capital gain. How can it be short-term if you have to use it for 2 years is the question. Guys, they have not used the word owned. They have used the word used. Generally, what happens is they use it for many years. They would have leased it out from somebody else, use it for many years, and then eventually purchase it. So they may have purchased it 6 months ago, so I don't care, but they should have used it for many years, minimum 2 years. So once you sell that urban agricultural land, what happens? You will now, once you sell that urban agricultural land, you will now what? Purchase one more urban or rural agricultural land within 2 years after you sell that thing. That's it. And other things remain the same. Proceeds will be invested in that, and you should deposit in capital gain account scheme and all those things. And lock-in period 3 years. Now there is one catch here. If I sell urban agricultural land and within 2 years I buy rural agricultural land, lock-in period is 3 years. If within 3 years I sell it off, then whatever I have claimed earlier will be not exempt. If I sell it within 3 years, then whatever I claimed earlier will be not exempt. But there's a catch here. This rural agricultural land, when I buy, I can immediately sell. This rural agricultural land, when I buy, I can immediately sell. Why? Still exemption can be claimed. Still exemption can be claimed. Why? Guys, very simple. Rural agricultural land is not at all a capital asset. When it is not at all a capital asset, why should I keep the property for 3 years? I can sell it off. Tomorrow, can they say that you have violated the terms by selling the capital asset? I'll say, boss, it was not at all a capital asset. I hope you're understanding. That is a hidden, loophole which can be utilized for tax planning. So you can make 20,000-30,000 rupees by giving this advice. See, each of you 30,000 rupees have given you, the trick to make 30,000-40,000 easily, depending on your client. I hope you understood. Okay. It's a tax planning thing. Don't tell anybody else, right? Yes, you use it. Next, exemption for compulsory acquisition of industrial land and building. Here, Raj Limited is compulsorily acquiring the land. Raj Limited, which is all SSC, is covered. For him, unfortunately, government is compulsorily acquiring the land. So his land, government is acquiring. What land has the government acquired? Industrial land and building. Unfortunately. And this also I should have used for industrial purpose 2 years before. I should have used for industrial purpose 2 years before. So Raj Limited, all SSC. When I say all SSCs, this section will apply to individual HF, AOP, BOI, partnership firm, all this, including company, LLP, everybody. So you should have used it for how long, guys? I should have used it for industrial purpose. 2 years before I should have used it for industrial land and building. Date of transfer. From when the day I sell it, I should, within 3 years, I should purchase. Guys, one more question you will arise, sir. I make a compulsory acquisition, government will make compulsory acquisition, and now only you are telling me within 3 years I need to buy. Sir, their compensation only they gave 4 years later. So is it 3 years from the actual compulsory acquisition or 3 years from the receipt of money? Is it 3 years from actual compensation which I received or 3 years from the receipt of money? It should be 3 years from the compensation receipt. 3 years of the compensation receipt, I will invest it in industrial land and building. And that I will deposit in what? Capital gain account scheme. Before due date of filing the return, I will do. And that's it. That will be exemption. And again, I should keep it for 3 years. No doubt about it. All that is the same. 54 EC. These are all bonds that I will buy. I can buy rural. What am I selling? What am I selling? I'm selling immovable property, land or building or both. In 54, I'm selling an asset, selling house property, buying house property in 54. In 54B, I'm selling urban agricultural land, buying rural or urban agricultural land. In 54D, compulsorily my land was acquired for industrial undertaking and I am also purchasing or constructing a new thing within 3 years. 3 years. 3 years from what? Getting the compensation. Again, what? I am constructing the new asset, which is same industrial undertaking only. This one, I am selling what? Immovable property. I am selling what? Immovable property. That is what? Land or building I am selling. I am selling what? Land or building. And what are the bonds which are covered? Rural electrification bond, national highway bond, power finance, Indian railway, all these bonds I am buying. These bonds will be redeemable only after 5 years. These bonds are redeemable only after 5 years. So for 5 years I need to keep it. So here, whatever amount I invest or maximum 50 lakh will be the benefit. Maximum 50 lakh. People were very smart. They were taking 50 lakh, 50 lakh, 50 lakh, 50 lakh for each of these things, 50, 50 lakh they were taking because there was no clarification. Right? Then Nirmala madam said, hey, cheating. Then she said what? Maximum investment in 54 EC, all bonds put together. Because it was actually like that. Said investment should be 50 lakh in bond. In bond means what? Separate bond. 50, 50, 50, 50. I will take. No. Can I take exemption under 54 and 54 EC? Yes. But in 54 EC only can I take multiple exemptions? No. Maximum 50 lakhs. Maximum 50 lakhs. So 5 years I cannot touch that. Lock-in period is 5 years. And the moment I sell it, within 6 months only I need to buy. 54 EE. These are all units issued before 1/4/2019. So it is kind of irrelevant now. This also 50 lakhs only, same thing. 54F. 54F is, 54 is what? Selling house, buying house. 54F is selling other than house, like jewelry, and buying house. Selling other than a house, shares, jewelry, but buying a house. It is long-term capital gain. Other things are the same, guys. I have to purchase a new asset 1 year before or 2 years after, construct 3 years after. And one interesting thing here is capital gain is not exempt based on the capital gain that you have invested. Here it depends on the net consideration that you have invested. Net consideration. In all the other cases they have told capital gain you have to invest. Here they are telling what? Net consideration you have to invest. So if your consideration is 80 lakh, expenses is 20 lakh, net consideration is 60 lakh, cost was 40 lakh, and you have got only 20 lakh gain. In all other sections, capital gain has to be invested. Here, this 60 only has to be invested. If this full 60 is invested, then you will get 20. You will get exemption. So, you only invested 40 lakh. So, if 60 lakh you had invested, you would have got 20 lakh exemption. You have only invested 40 lakh. So, you will got 40 into 20 by 6. This is what you will get, 60. So, you will only get how much? 13.33 lakh exemption. So, here very interesting, net consideration has to be invested and proportionately you will get capital gain exemption. This also lock-in period is 3 years. Then you see this one is what? Land, building, plant and machinery, rights of land used in industrial undertaking in urban area. Urban area. Long-term gain. I buy one more land, building, etc. in rural area. This is conversion from urban area to rural area. Urban area I sell off the land and buy in rural area. Same. When should I buy? 1 year before or 3 years after the date of transfer? Same I will get. Same as, other things are same as section 54. Then 54 GA. 54 GA is what? Transfer from urban area to special economic zone. If I want to shift to special economic zone, special exemptions are given. Land, building, plant and machinery, rights in land and building in urban area is transferred to special economic zone. Other things remain the same. 1 year before or 3 years after you have to do it. And SSC cannot transfer the new asset within 3 years. Lock-in period 3 years. There are certain important notes on these exemptions. I'll quickly summarize a few points and then you can read it later. So I can claim multiple benefits, 54, 54 EC, separately I can do it, no problem. So it says, no, I should construct the house within 3 years. Can I start construction before 3 years only? Yes. When can I start the construction? Not given. When should I complete the construction? That only should be done within 3 years. Right? So if there are two flats, side by side, I demolish the wall and make it into a single flat. Is it considered to be one house or two homes? Even though the agreement, registration, everything is separate, I am living in one dwelling unit. Since I am living in one dwelling unit, there have been cases where they have told it can be treated as one house. Now anyway, you can treat it as two homes also because the new amendment has come anyway, no problem. Right? So this entire deposit of the capital gain in the capital gain account scheme is a procedural requirement which you need to follow. Even in case you cannot follow it also, here and there if there is a delay, government will allow, not a problem. It is not a problem. No issues. Right? And yeah, I should purchase the house within next 2 years. Right? And I should construct within 3 years. That's okay. I should purchase within 2 years. Purchase means what? I should get possession or I should get the registration. Ideally, I should get the registration. But guys, I've paid the entire money, but the builder only has not given me the new house. There's a delay. Is there a problem? I went to the Nirmala madam and said, Madam, see, I have paid everything from my end, madam. I sold the old house. For the new house, I have given everything. This fellow only has not given me the possession or registration. Nothing he has given, madam. What can I do? If it is the delay in the part of the builder and not my delay, pardon, no problem. I will get the exemption. Absolutely no issues. Can I get exemption on more than one provision? Yes. Definitely yes. But then there is this entire summary. Sorry, entire summary is there. Next. There is also exemption on urban agricultural land we already saw. But what if that urban agricultural land was compulsorily acquired, guys? Then under 1037, there is an exemption. If an urban agricultural land was taken away from you compulsorily for some infrastructure project or whatever, if I had used it for 2 years before, it is compulsorily acquired, that entire capital gain will be exempt, no problem. Apart from that, in Andhra Pradesh, they were developing Andhra Pradesh and they were making Amaravati city. They took over certain land and they created something called as the land pooling ownership certificate. They took over all the land of the people to construct Amaravati and then they said, we will give you this land value somewhere else. For that, I will give you a certificate, land pooling ownership certificate. And this you can also go somewhere else and you can invest or you can sell off this, no problem. I'm giving you, you have given me land worth 1 crore, take this certificate, 1 crore. And that will obviously add value, it will keep on increasing the certificate value. Tomorrow you can sell it off for 1.5 crore. That 50 lakh, is it exempt or not? Answer is yes. 1037A, that 50 lakh is also exempt. This is called as the land pooling ownership, certificate. Right? Yes. These are all the points. Moving on. So after this, guys, after the exemptions are done, next part is tax rates. Now here is where it is the most important part. Why? Tax rates. Important. Why is it important? Because Nirmala madam has changed the tax rates, as you know. First, what did she change? She changed the concept of indexation. Little bit extra she did there, we'll have to discuss. And then she now changed the tax rate. So, very, very important for May 2025, November 2025 onwards. From now, especially for May 25 and November 25, because there is a date question here. 23rd July. After that, everything is different. Predominantly for these 3-4 attempts, 2-3 attempts, things will, you have to remember both the dates, both the rates also. Because before this thing, something else, and after 23rd, something else. Before 23rd, something else, after 23rd, something else. So to remember both the rates. May 25, November 25, it will be predominantly important. Let's do it, shall we? It's easy, don't worry. We'll break it down. As usual, we've been breaking it down, we'll break this down also. So, quick history just to understand, because you need to know where we are coming from. Before 2004, anything that you did in the stock market, there was, concept of LTCG, 20%, and short-term capital gain was normal rate. In 2004, I'm talking about 20 plus years ago, Chidambaram, called the Lungi man, always he comes in white. He introduced a concept called Security Transaction Tax, STT. And for commodity market, he introduced Commodity Transaction Tax. So what is it? STT, Security Transaction Tax, CTT, Commodity Transaction Tax. So here he said, from 1st October 2004, he said, any LTCG is exempt, no need to pay tax, because already there is a separate tax which is collected called as Securities Transaction Tax. This was everything in the share market. Right? So 1/10/2004 LTCG exempt at 1038. Then short-term capital gain, he said, let's reduce the rate. No, normal slab rate can be other things, but for share market transactions, let me make it 15%. This was what was given in 2004. I am telling you the history only because you should know where we are coming from. Correct? Knowledge of history is always very, very important. Right? So before 2004 LTCG 20%, STCG normal slab rate, and 2004 FM had told what? LTCG now let's make it exempt because I'm collecting something called as what? Securities Transaction Tax. And STCG 111A 15%. In the year 2018, in the budget, on 1/2/2018, Arun Jaitley ji removed 1038 and introduced taxation on what? Securities market. He said, I'll remove 1038 exemption, and for long-term capital gain for share market, 112A. 112A is for what? Equity-oriented funds, equity shares, other things, and units of business trust. I will charge a rate of 10% in excess of 1 lakh rupees. So 1 lakh is like the basic exemption limit, and after that, how much I'll charge? 10% for LTCG. STCG still remain 15%. And he said this is for what? This is for STT. Anything that has gone through STT only. Anything that has gone through STT only. Very simple. So for equity shares, equity oriented mutual fund, and units of business trust, he said up to 1 lakh is exempt. Beyond 1 lakh, I will keep it 10%. And this is for those companies where STT, those shares where STT has been paid. STT is paid both on acquisition as well as transfer. Those equity shares, STT should be paid on the units or equity oriented units and units of business trust. For those items only, I will take this into account, is what they had clearly mentioned. Now, this part also has definitely changed, my dear friends. This part also has definitely changed. That is what we need to understand. Has it changed? Definitely yes. Let me come to that now. One second. So 112A was speaking about what? Quoted shares, that is quoted in the stock market. What about unquoted shares? Unquoted shares was very simple, guys. What do you mean by unquoted shares? I need to explain this and then we'll go there. What is unquoted shares? Unquoted shares are the shares which are not listed. They are called unquoted shares. Or even if they are listed, they are not traded regularly in the market. They are called as penny stocks. So what are unquoted shares? Shares which are not listed, and they are also called, they are listed but they are not traded regularly. That's why they are called as penny stocks. So the share value is less than the FME of such shares. If the share value is less than FME of the shares, then FVOC is equal to FME. Then the full value of consideration is equal to fair market value. So unquoted shares are what? Shares which are not listed. Other one, it is listed but it is not traded regularly. They are called penny stocks. If the share value is less than FME of such shares, then FVOC is equal to FME. Very, very simple. Which means that if the share value, whatever you do the valuation, if it's less than the FME, you cannot cheat them, right? You cannot say that now the share value is, what do you say, 100 rupees, but the FME is 90 rupees. Then the FME will be what? The value of the share only is less than the FME, means my entire FVOC will be the FME itself. Because if the share value, let's say, is 90 rupees, sorry, and FME happens to be 200 rupees. You are selling the share at 90 rupees when in fact the FMB happens to be 200 rupees. So what will be the full value of consideration? 200 rupees. On the other way, the share value is 80, but the FMB is only less 60, then obviously you should take the share value. That is obvious. But here what used to happen in penny stocks is the share value will always be less. FMB will always be more. You will take the FMB or share value. FMB is what you will take. Now, in the same context, now let's come to the tax rates which are there as of now, guys. So this is a very, very important thing, whatever we're going to discuss. Yes. So tax rates for the year 2024. Tax rates for the year 2024. Section 112A, Section 111A, and other than 112A and 111A. This is the overall tax sheet. I'll give you time to copy it down, because this it's better if you copy, but let me just explain first, then we can copy. Now guys, very simple, 112A and 111A. These two sections, 112A and 111A, are for what? Equity shares, equity oriented funds, units of business trust, on which STT is paid. I repeat, equity shares, equity oriented units, units of business trust, on which STT is paid. It is mandatory to follow this section. It is mandatory to follow this section, and there is no indexation at all. It is mandatory to follow this section, and there is absolutely no indexation benefit or nothing is given here. It is mandatory to follow this particular section. Equity shares, equity oriented units, and units of business trust. Okay. You can't follow some other section. You have to follow this section. Now, guys, we need to remember the date now. All the shares sold till 22nd July 2024. Shares sold till 22nd July 2024. 112A, 111A. 112A, LTCG, 10% in excess of 1 lakh. 10% in excess of 1 lakh. 10% in excess of 1 lakh is taxable, same like whatever Arun Jaitley told. And short term capital gain is what? Short term capital gain is what? 15%. That is what Arun Jaitley had released in 2018. Arun Jaitley had released in 2018. From 23rd July 2024. From 23rd July 2024. It is 12.5%, my dear friends, in excess of 1.25 lakh. 12.5% in excess of 1.25 lakh. So guys, earlier also, do you think you'll get indexation for 112A? No, no indexation. No indexation. Whereas from 23rd July 2024, it is 12.5% in excess of 1.25 lakh. There, 111A STCG till 22nd July 2024, 15%. And from 23rd July 2024, it is what? 20%. So here, Nirmala madam has increased from 15 to 20. Here she has increased from 10 to 12.5%. And this 1.25 lakh, 1 lakh has been increased to 1.25 lakh. So, people who are holding shares for a longer, and period of holding also she has changed. Period of holding used to be 1 year, 2 year, 3 years. Now it is only 1 year and 2 years. So it is better if you hold the shares as a long term because it will be, what do you say? The share price, I mean the percentage has increased, it's okay. But this also you are getting a benefit of 1.25 lakh. And your short term definitely is not at a benefit for you because 15% is increased to 20%. And this is only for these items: equity shares, equity oriented units, units of business trust. Mandatory to follow this particular section. No indexation. Now we will come to the other area. Other than 112A and 111A, my dear friends, other than 112A and 111A, long term capital gain, section 112, and short term capital gain. Short term capital gain, there's absolutely no change. Other assets means what? Other than shares, jewelry, property, all those things. Short term capital gain, but period of holding has changed. Period of holding is 1 year and 2 years now. Short term capital gain, normal tax rates. No change in the Finance Act. But long term capital gain, till 22nd July 2024, till 22nd July 2024, it was 20% with indexation. How much was it? 20% with indexation. From 23rd July, 2024, I need to see now. I need to see if asset is a immovable property. Guys, actually what happened was from 23rd July she told there is no indexation concept only. Overall it is 12.5%. That's all. Very simple. Long term is I don't want separately for what do you say, shares, separately for everything 12.5%. Made it simple. It's actually simple. But then these people who are having the homes, no, residential homes, they started crying. Ma'am, my great tata had a house 80 years ago. He bought it for 10 rupees. That is now standing at 50 crore rupees. And now you are telling me 50 crore minus 10 rupees into 12.5%. What about indexation? So, lot of fighting, etc. happened. So, Nirmala madam gave an option. Okay, don't cry. I told for everybody, all assets, all long term 12.5%. I told, okay, but small change I will make. And I told no indexation. For jewelry, is there any indexation? No, no. Indexation concept only is removed now. Indexation concept is removed now. Hope you are getting it. So she said very simple, guys. Selling price minus cost into 12.5%, chapter close. Easy. Let's make it easy. But these people who are not companies, individuals and HF are coming and crying. We have family property, do something. Okay, jewelry and all you leave, madam. I don't want indexation. Family property, you give indexation. So if the house is sold even after 23rd July 2024, Nirmala madam said, okay, only in one case I will give indexation. Only in one case I will give indexation. First of all, it should be immovable property. Second of all, it should be HUF and individual only. So I'll give you, what is it? Two options. One, you do that 50 crore minus 10 rupees into 12.5%, chapter close, no question asked. 12.5% you do and close the matter, no questions asked. Okay, that is one. Second is what? Okay, now you're crying, you're telling that you want indexation. Okay, Baba, take indexation. Take indexation. 20% with indexation you take, no problem. Take 20% with indexation. Means what? Same like before, 20% with indexation. Means what? FMB benefit of 1/4/2001 net FMB we should take. Your great father 80 years ago he did, but take the FMB as on 1/4/2001, take the FMB. And then put the indexation till today. 363 divided by 100 you do, no problem. And then you calculate what? Since I've given you indexation, calculate 20%. Are you understanding? So, if the asset is immovable property, only for residence, individual and HF, 20% with indexation, 12.5% no indexation. If it is others, 12.5% no indexation. 20% in indexation, 12.5 no it is only at the option of the SSE, only and only if the if asset acquired before 23rd July is sold. Most important. Only if asset acquired before 23rd July is sold. Asset should be acquired before 23rd July, sold after 23rd July, which means old properties is what they're saying. All assets which you purchased after 23rd July, there is no indexation even if it's immovable property. You bought an asset on 1st August. You are selling it in 2nd February 2025. You bought the asset on 1st August 2024. You are selling the asset on 24th February 2025. No mercy, no indexation. Sir, I'm an individual. I don't care. This provision is applicable only if you buy the asset. If you would have bought the asset before, what? 23rd July 2024. Okay. Hope you got it. Then I'll give you time to write down. Don't worry. Proviso to section 112. Provision to section 112. What does it say? See. Earlier, no? LTCG on listed security other than units and ZCB. LTCG on listed security other than units and zero coupon bonds. Why? Because listed units are anyway covered under 112A, but this was for other things. Listed preferences, equity shares on which STT is not paid, listed bond, listed debentures. Now, till 22/7/2024, it was 10% without indexation, 20% with indexation. From 23rd July, it is 12.5%, no indexation. No indexation. Right? You see, if land and building is acquired after 23rd July 2024, even if it's an individual or HF, or if land and building is sold by other SSE, apart from individual or HF, even if he has acquired before 23rd July 2024, 12.5% only will come, no indexation. So, if cost of acquisition in 1990 is 5 lakhs, 1/4/2001 FMV is 10 lakhs, sold on 24th July 2024 is 1 crore. With indexation, you will take FVOC 1 crore minus index cost of acquisition 10 lakh. 10 lakh into 363 by 100, LTCG will be 63.7 lakh. Tax at 20% will be 12 lakh 74,000. Or without indexation, 1 crore minus. Guys, cost of acquisition, important point to know. Cost of acquisition, should I take 5 lakh or 10 lakh? I should always take FMB as on 1/4/2001, 10 lakh. That FMB benefit is given to both cases. Income tax department has clarified already. So FVOC 1 crore minus cost of acquisition 10 lakh, LTCG 90 lakh. Tax at 12.5%. 11 lakh 25,000 will come. 11 lakh 25,000 will come. Hope you got it. Yes or no? Right. So I still have to do market linked debentures. We'll do it. This is the overall thing, guys. Now, market linked debentures. Market linked debentures were part of proviso to 112. Market linked debentures were part of what? Proviso to 112. But in Finance Act 23, they made it part of 50AA. Market linked debentures were part of proviso to section 112. But in Finance Act 23, they made it a part of 50AA. Which means this will also include unlisted bonds, unlisted debentures, In Finance Act 2024, they said anything which is market linked debentures will also include just not market linked. It will also include what? Unlisted bonds, unlisted debentures, everything. Finance Act 24 has told market linked debentures will include unlisted bonds, unlisted debentures, and it is not part of Proviso 2112. It is a separate section called 50AA. It is a separate section called what, guys? 50AA. That's what the thing was, 50AA. Now, what is this 50AA? I'll give you, in 50AA, one thing was pending, remember? I told you we'll do later. That is what we're doing now. 50AA. What is 50AA? Let's see. Guys, concept I'll explain, and then you can figure out the rates, etc. So now, any investment that I make, right? Any investment that I make, I can make investment in equity. I can make investment in mutual fund or other things. I can make investment in fixed deposit, or I can make investment in savings bank account. Okay. If I make investment in fixed deposits and savings bank account, the interest that I'm going to get will be taxed at the slab rates, as we all know. Fixed deposit and savings bank interest, both I will be charging at the slab rate. That goes without saying. But if I am investing in equity, if I am investing in equity, if it is more than 12 months, then it will be long-term capital gain under 112A. It will be 12.5% in excess of 1.25 lakh. That is from 23rd July 2024. On the other hand, if it is less than 12 months, obviously short-term capital gain, it will be 111A, 20% from 23rd July 2024. That also we know. What about others? If I invest in mutual funds, it could be equity, debt, or hybrid. If it was equity, we already know it is called equity oriented fund. That will come under this category. What category? 12.5% or 20% category. It will come here. But debt or hybrid funds, this debt or hybrid funds, this will include market linked debentures. Okay. So what used to happen was, any debt fund or hybrid fund. Debt fund is what? More than 50% is into debt funds. Hybrid fund is what? Part of debt, part of hybrid. Part of debt, part debt, and part equity. And part fixed and part linked to market. All these various bonds and debentures, they started releasing. Different investment schemes they started releasing all the in the entire market. Of course, following SEBI guidelines and all those things. So, this debt and hybrid will now include what? Market linked debentures. Market linked debentures, if it is less than 24 months, no, it was always slab rate. But if it was more than 24 months, no, it was part of this 112 proviso. It was part of this 112 proviso where you would to do 10% without indexation, 20% with indexation, all those things, it was there. But guys, now, very simple. In the Finance Act 23, they told very simple. Everything is deemed to be short term. Whether you do less than 24 months, more than 24 months, I don't care. Everything is short term. There is no 12.5% also. For market linked debentures, a new section was opened for this part, debt and hybrid. New section was opened called 50AA. And they said, anything you do, hold less than 12 months, more than 12 months, 24 months, I don't care only. If it is not equity oriented, if it is not the other one debt, it is purely market linked debentures. How much? Everything is deemed to be short term, everything is taxed at slab rates. Deadly, easy. Now, what do you mean by market linked debentures? Two things. One is market linked debenture should be there, which is the debenture linked to the market, basically something like listed debentures. It can be acquired anytime. Or it could be specified mutual fund. That specified mutual fund should be acquired after 1/4/2023. 1/4/2023. What do you mean by debt fund? They have now defined. It is any debt fund or any money market instrument in which more than or equal to 65%, or not more than equal to, more than 65% should be in debt. It is debt or money market instrument where more than 65% should be in debt. Right? So there were some gold funds, exchange traded funds where the investment was less than or equal to 35% in equity. So that was removed also, guys. So very simple. Now definition is very simple. What is specified mutual fund? Which is market linked fund, which is coming under 50 AA. Any debt fund which is more than 65% in debt will be debt fund. What used to happen earlier was, even for this debt fund, they were giving the benefit of 12.5%, 20%. They were nothing doing. Debt fund or market link fund is as good as fixed deposit and savings bank deposit. Risk is less, return may be higher than fixed deposit. So why the hell should I give you benefit of 12.5%? It will be direct slab rate. It will be slab rate, no questions asked. Very simple. It will be slab rate, no questions asked. Got it, guys? Did you understand? Earlier, the definition was debt fund will be investment in equity should be less than or equal to 35%. Like that, it was there. But it is because there are some gold funds, exchange traded funds, etc. They actually invest in less than 35%. But the rest of that will not be in debt. It will be in other things. So they removed everything. They do remove. Now, what should you remember? What is specified mutual fund? It is where the debt is more than 65%. That's it. That is called specified mutual fund. Or it could be any market linked debentures. Then it can be acquired anytime. Specified mutual fund should be acquired only after 1/4/2023. This is the concept regarding which one, guys? Investment in 50 AA mutual funds. Got it? One more interesting thing I want to tell you with this. 50 AA, that's all. Now one more interesting thing, hear me out. Then we can break for lunch, okay? Very interesting thing. You'll really like this. Right. Now my one question to you is, Arun Jaitley ji said on all these things, whatever is happening, right? On 31st January 2018, because this was brought to force on 31st January 2018. What? He brought the tax for the very first time, no, 10%. Anyway, now it's 12.5%, but let's talk about this 10%. He brought into tax only on 31st January. From 2004 to 2018, there was no tax on the share market transactions. I'm only talking about 112A and 111A. What was 10% in 31/1/2018 has now become 12.5%. And but it's okay. But what I'm trying to tell is, when on 1st February Arun Jaitley ji announced this budget was obviously applicable from 1st April 2018, which means still 1 month was there. 2 months were there, February, March, 2 months. So he's telling from 1st April 2018, tax will be 10%. That's what he said. Guys, if from 1st April 2018 tax would be 10%, don't you think so everybody will offload their shares in 2 months? Yes. Because in the next 2 months there is no tax. Assume I have bought it in 2014 share for 100 rupees. And on 1st February 2018, that share value is almost 700 rupees. Basically, on 31st January 2018, share value is 700 rupees. So, my capital gain would be what? 700 minus 7 minus 100, 600 rupees gain. If I sell it between February and March, this capital gain is exempt. I can enjoy that capital gain. But if I sell it on 1st April 2018, I have to pay 10% tax. What will you do? Common sense. You will sell it off. So Arun Jaitley came out with a very brilliant concept. Arun Jaitley came out with a very brilliant concept. He said that on 1st February, I'm announcing it, I know. But he said a very beautiful thing. He said, cost of acquisition. Cost of acquisition. If you have bought it in 2014, for example, cost of acquisition will not be this. He said, whatever happened in the past is grandfathered. He used the term grandfathered. Means what? Ignore everything. Cost of acquisition you should take as on 31/1/2018, and he said FMB as on 31/1/2018 only will be the cost of acquisition, and he closed it readily. FMB as on 31/1/2018 only will be your cost of acquisition. Means what? Means what? It means that if at all you know the value of your asset, of your share is 700. He said cost also will be 700. So your capital gain will be 0. So he's trying to tell, even if you sell it today, there is no point. You were selling because you were making gain of 600. I am telling past, you forget about the past. Cost of acquisition will be the FMB as on 31/1/2018. Deadly point. Not just now, any time in the future, if you want to sell, you should take the FMB as on 31/1/2018. You remember that on 1st April 2001, FMB will be the cost. Similarly, he added this also for share. So for share, you should take the cost as on 31/1/2018. And what is the cost? FMB, readily. He basically gave the indexation automatically, just like here on 1/4/2001, by giving FMB, I have given indexation, no? From there, indexation is available. Correct? For a property, if I bought in 1980, let's say for 10,000 rupees, I should calculate FMB as on 2001. This FMB of 2001, let's say it is 5 lakh rupees, automatically gives you indexation. And then when you sell the asset in 2024 now, or 2025 when you sell, there are two options. Either take indexation, 363 by 100, you take indexation for the cost, 5 lakh into you do, or you just do whatever. Let's say you are selling it for 1 CR. You do 1 CR minus 5 lakh into 12.5% and close. That's your wish. You know that already. Similar to that, he brought it for shares. For shares, when am I changing the entire law? From 2004 to 2018, you didn't pay anything, boss. On 31/1/2018, I am telling that entire cost, whatever you paid for, remove. I don't care. He gave a formula. He said what? The FMB should be taken into account. Here it is cost or FMB, whichever is higher. Here also I told the same thing. Cost or FMB as on 31/1/2018, whichever is higher, you take and close it. That will be the cost. Simple. If the share you bought it at a higher rate, today that company is full, become Chapadasi company, you take cost or FMA, whichever is higher, and close it. Beautiful. Which means after 31/1/2018, if you want to sell any share, if it was bought after 31/1/2018, no problem. What if it's an old share? You should take cost or this FMB, whichever is higher. Wonderful concept. Now comes the question, sir, what about bonus share, sir? Remember, bonus shares issued before 1/4/2001, cost would be nil, or FMB, whichever is higher. And I told you after 1/4/2001, right? It is what? All the bonus shares issued after 1/4/2001. I told you, very simple. What was that? They said cost will be nil. Makes sense. But now my question is, bonus issued after 2018, cost will be nil. But in 2010, I received bonus shares for nil on 2015. In 2015, I received bonus shares for nil. Nothing, bonus is free I got. And this bonus share, I am selling it in 2020. This bonus share, I am selling it in 2020. I am selling it for 1000 rupees. Cost is nil. So what should be the capital gain? 1000 minus nil, 1000. But Arun Jaitley gives a benefit. Arun Jaitley, what does it say? Cost or FMB, whichever is high. FMB, let's say some 500 rupees of that share. He is giving the FMB benefit for bonus share also, important point. So simply put, whether it is normal share, bonus share, right share, whatever it is, anything before 31st January 2018 is grandfathered. Means what? FMB you should take as on 31st 2018. Cost whenever you bought it, or FMB as on 31/1/2018, whichever is higher. So he came out with a beautiful formula. Came out with a beautiful formula to tell this one. Cost of acquisition. Section 55 inserted. Cost of acquisition. If section 112A applies and asset is acquired before 1/2/2018, then cost of acquisition shall be step number 1, cost of acquisition, or step number 2, FMB, whichever is less. But he added one more thing, FMB or sale value, whichever is less. Why? Because as on, for example, if a company called Kingfisher, just assuming, Kingfisher on 2018, the FMB was 200 rupees. But when I am selling in 2020, it has fallen to 10 rupees, assume. And when I bought the share, the cost would be 100 rupees. So what should I do? 2018 FMB and 2020 sale value, this or this, whichever is less, 10 rupees. Should take 10 rupees. See, generally FMB as on 2018 will be 200, and whatever I sell more, in 2023 I am selling it for 250 rupees. Always it will be more only. That's why they are saying FMB or sale value, whichever is less. So 200 or 250, whichever is less, 200. Then 100 or 200, whichever is high. 100 or 200, whichever is high. That's okay. But in a very rare circumstance whereby FMB as on 2018, company was doing very well in 2018. Now it has become horrible. Then they are saying this or this, whichever is less. I should take this or this, whichever is less. Otherwise, you know what will happen? Tell me, this will happen, guys. Think about it. If this dialogue was not there, no, I bought the share in 2014 for 100 rupees. FMB as on 2018 is 200 rupees. I am selling it for 50 rupees, assume. If the dialogue was not there, full value of consideration 50 rupees I'll take. Less cost or FMB, whichever is high, 200. Loss, capital loss of 150 it will become. Now with this dialogue, what should I do? FPOC is equal to 50 only, no change. Cost of acquisition. First I should do this or this, whichever is less, 50. Then I should do this or this, whichever is more, 100. So now it will be 100. The capital loss is just 50. See the difference? Beautiful. Wonderful, wonderful formula. Got it? That's the logic. Logic I explained. So it is what? Higher of step 1 and step 2. Higher of step 1 and step 2. Cost of acquisition, step number 2, 31/1/2018, this or this, whichever is less. So step number 1, cost of acquisition. Step number 2, FMV as on 31/1/2018 or sale value, whichever is less. Then step number 1 or step number 2, whichever is more. Obviously, indexation benefit is not available. Indexation benefit is not available. Yes or no? Yes. So now we'll continue. So guys, so we had done this cost of acquisition. Section 112A applies for an asset which is acquired before 1/2/2018, and the cost of acquisition was this. Higher of step 1 and step 2. I hope you understood the logic. So technically, bonus issued. Bonus before 1/4/2001, cost or FMV, whichever is higher I should take for bonus. After 1/4/2001, for all 112A cases, equity shares, units listed STT, for everything, for other non-112A cases, that is for unlisted shares, cost of acquisition will be nil. But for listed shares, bonus shares on listed securities, you will get the benefit of 31/1/2018. Benefit of FMV is available. Benefit of FMV is available. Right. So, how will I calculate the FMV as on 31/1/2018? What is the procedure or formula to calculate the FMV? Because it's at FMV, okay, but what is FMV? Fair market value. If it is listed, then absolutely no tension. If it is a listed share or unit, absolutely no tension. I should take the highest price quoted on 31/1/2018. Highest price quoted in that respective stock exchange. But if that asset is, if that share is sold both in NSE and BSE, then whichever has the highest volume, that volume I should take. So if the volume of shares was more in Infosys in BSE, then I should take BSE rate. Highest price quoted on 31/1/2018. But if it's an unlisted share, what to do? If it's an unlisted share, then FMV, if it's a unit, FMV will be NAV as on 31/1/2018. And if it is a normal share, unlisted share, not unlisted units, NAV I cannot take. What will I take in that case, guys? Cost of acquisition into index for the year 17/18, because I am bringing whatever was there from the day I bought till 17/18. So index of the previous year 17/18 divided by index of the year of acquisition. So index of the previous year 17/18 to index of the year of acquisition I should do. Very simple. It's normal. It's like I bought it in 2004, but I need to bring it to 2017/18. So what will I do? Cost of acquisition into index of previous year 17/18 and from the previous day, that is index of the year of acquisition, I should do it. Very, very simple. So FMV will be what? NAV as on 31/1/2018. Very, very simple, guys. Very simple. Tax rate and all we have already discussed. We have discussed the tax rate. So this part you had already gone through. Now see point number C here. Of course, and whatever I calculate, no, I should increase it by the surcharge and health and education cess. That goes without saying. So long-term capital gains under 112A can be used for exhausting the basic exemption limit. In other words, long-term capital gains under 112A shall be reduced by the basic exemption limit, and only the balance shall be taxed at either 10% or 12.5%. For example, Mr. Y, a resident of 65 years, derives taxable pension and interest income of 2 lakh and also derives long-term capital gains of 5 lakhs on transfer of equity shares. So tax on other income, I should, obviously it will be nil because the pension is taking 2 lakh, but since it's 65 years in the old regime or even in the new regime, 3 lakh is the basic exemption limit. So 3 minus 2, 2 lakh is anyway there, 3 lakh is the BEL, that is there, basic exemption limit. So 3 minus 2, 1 lakh. 1 lakh is the unexhausted basic exemption limit. 1 lakh is what? Unexhausted basic exemption limit. Now, that unexhausted basic exemption limit will now be set off against this 5 lakh, guys. Right? So, unexhausted 1 lakh will be set off against 5 lakh. So, basically, we have income from long-term capital gains 5 lakh, less unexhausted basic exemption limit 1 lakh, balance capital gain will be 4 lakh. Tax up to 1 lakh will be nil if it happens before 22nd July. After 23rd July, on or after 23rd July, 1 lakh 25,000 will be subtracted. And if this happens before 22nd July, 23rd July, 4 lakh minus 1 lakh into 10%. Otherwise, it will be 4 lakh minus 1 lakh 25,000 into 12.5%. That's all. That is what I am trying to tell. That's what we should see. This concept of availing basic exemption limit, etc., will not be applicable to a non-resident individual. It will not apply to a non-resident individual. It's only to a resident individual. Similarly, rebate under 87A is also not applicable. Anyway, in the new regime, it's very clear about the rebate concept. So whenever there is a LTCG under 112A, rebate under 87A is not applicable for that income. You see this example, Hamsa, resident individual, age 37 years, LTCG 112A is 1 lakh 60, other income 3 lakh 20. In this case, Hamsa's basic exemption limit is 2 lakh, assuming it's the old regime. Tax on other income is what? 3 lakh 20 minus 2 lakh 50 into 5%. So 3,500. Tax on LTCG is 1 lakh 60 minus 1 lakh because it is the old regime and also the shares were sold before 23rd July, assume. So 10%, 6,000 rupees. Total tax 9,500. In the old regime under 87A, rebate was 9,000, rebate was 12,500 or the tax computed, whichever is less. Here it is 9,500, but I should not take it under 9,500. I should not take it under 9,500 because very clearly I should take only what? Tax amount 3,500. I will not get any rebate on this amount. I will not get any rebate on 6,000 rupees. I will not get any rebate on 6,000 rupees, guys. That is the thing. You will not get any rebate against what? LTCG under 112A. So what will be the rebate amount? Tax amount 3,500. This amount 3,500 or basically 12,500, whichever is less. So what will I get? 3,500. So remaining I have to pay tax for sure, no doubt about it. Registered on the stock exchange, higher price, units of mutual fund, all those things. Now there is also one interesting case. What if as on 31st 2018, 31st 1st 2018, this was a unlisted company. For example, Nykaa, Zomato, Paytm, Swiggy, all that on 31/1/2018 is unlisted. But as of today, when I am selling in 2025, if I am selling, it is listed. So what did the lawmaker had told that time? The lawmaker had told, that is Arun Jaitley ji had told, benefit of 31/1/2018 will be available to everything. FMB I have to take. Fair enough. Now the question here is, that time it was listed, now also listed, no problem. What if that time it was unlisted and now it is listed? What to do? There was a confusion. What should be the FMV I should take? What should be the FMV that I should take? So actually speaking, it's indexation only I have to give, no? If you remember this one, at the time of buying, what was it? It was unlisted. So what should I take? I should take this only. Cost of acquisition into index of 1718 by index of year of acquisition, but there was clear-cut confusion. They didn't know what to do. Some people were thinking that should I take, what should I calculate? Because that time it was not listed. So should I do something else? So to clear all the confusion, they have given here FME shall be equivalent to index cost of acquisition. That indexation shall be given only till 1780. So that also they have added. It is not listed on that day, but listed today. Same provision. It is understood only, but they have clarified it very, very clear in Finance Act 2024. In Finance Act 2024. So it is a part of OFS or offer for sale, initial public offering, all those things. This you can just go through, leave it, no problem, no need. Benefit of indexation, and short term also same thing. Whatever we have discussed, short term also will be the same thing. 112A, 112A and all those things. Then other long term capital gain also we have discussed. Everything. Then relaxation, you see, relaxation for resident individuals, all that we have seen. For everything, zero coupon bond, whatever you do, everything we have given the chart becomes very, very simple. And ultimately, this is the final rates for everyone. Then we have short term, that is taxed at normal rates. So that's about it. Some miscellaneous points. One, I spoke about non-resident. One more, if you remember, we had not done a concept called consolidated scheme. It was there before. See, wherever it is AOP, BOI, partnership firm, I told you in the respective chapters, we will cover that. Business trust also. But I remember, ULIP anyway we did, but one point was missing, that is the consolidated scheme. So what is that consolidated scheme? Very simple. If, for example, mutual fund, you have a equity oriented scheme and you have a debt oriented scheme. So equity oriented scheme is where greater than 65% of investable funds is there in equity shares. Debt oriented scheme will generally be a government debt oriented scheme, private debt oriented scheme, and private and government debt oriented scheme. So what they are trying to tell is, let's say in a equity oriented scheme, there will be, let's say, 6 things: FMCG equity oriented scheme, pharma equity oriented scheme. So basically these mutual funds will only invest in pharma companies, will only invest in what do you say, FMCG companies, will only invest in banking companies, Nifty, and all those things. Now, in FMCG equity oriented fund, you have 3 plans. For example, growth plan, dividend plan, growth and dividend plan. So what they are trying to tell is, if from one fund you are transferring to another fund within the same equity oriented scheme, it is not considered as a transfer. So if I am transferring from FMCG to pharma, no problem. If I am transferring from dividend to growth, no problem. Growth to growth plus dividend, no problem. That is the beauty of the concept of consolidated scheme. Consolidating scheme is a scheme which is getting merged into another one. Final scheme is called as consolidated scheme. So if FMCG plus pharma is going equity oriented scheme, I am merging into something called XYZ equity oriented scheme, then no problem. If on the other hand, if this is not allowed, you see, FMCG and government, FMCG is equity, government is debt, both I am merging into equity oriented scheme, then that is taxable. Capital gain it is. It's not a, it is definitely transfer. You can't call it, it is not a transfer. Okay. Then government scheme and what do you say, government POS and private POS, that is debt oriented scheme. Government debt oriented scheme and private debt oriented scheme is merging to equity oriented scheme, that is also transfer. What is not a transfer? As I told you, this one here. FMCG equity oriented is converted to pharma equity oriented, no problem. Growth plan is converted to dividend plan, no problem. Growth is converted to growth plus dividend, no problem. So these things, not an issue at all. Not an issue at all. Okay. This is the thing. Apart from that, let's see. So a non-resident, just to merge non-resident with capital gain also. Non-resident, if he sells preferences, debentures, deep discount bonds, unit of debt mutual fund and all those things, 111A will not come, 112A also will not come. As we know, it is only the normal rates. However, if he sells equity shares, units in equity oriented fund, units of business trust, this will automatically attract what? 112A. But if this is happening at what, guys? IFSC. So you should always have a lookout. If anything is happening at the recognized stock exchange in IFSC, if it's happening where? A recognized stock exchange in IFSC. If it is denominated in foreign currency or Indian currency and it is paid in foreign currency, or if it is denominated in Indian currency, paid in foreign currency, whatever the case may be, there is no STT also. 47 7AB exempt. Under 47 7AB, it is not taxable. So there is a lot of exemption for non-residents, especially if it happens at the IFSC, at the IFSC. Now, one more interesting thing to notice, STT, should it be done at the time of purchase or should it be done at the time of sale? This also MCQ questions can come. Security transaction tax, when should it be deducted? At the time of purchase or at the time of sale? So guys, for 112A and 111A both to be attracted, it should be done where? Both at the time of purchase and sale. If it is done at the time of purchase but not at the, if it is not done at the time of purchase but done at the time of sale, 112A will not come. Imagine. 112A will not come. Then it will go to the normal areas. Okay. So when 112A come, at the time of purchase also I should have paid STT, sale also I should have paid STT, then 112A will come. Similarly, at the time of purchase and sale, if I have paid STT, 111A will come. Right? 112A is for equity oriented funds, then units of business trust and listed securities. At the time of purchase, I have not done STT, but at the time of sale, I have paid STT. Then 112A will not come, but 111A will come, because 111A condition is very simple. You should only deduct STT at the time of sale. At the time of sale. So, for example, if I purchased unlisted shares like Nykaa, just give an example. Nykaa, Paytm, and that when they were unlisted only I purchased. As a private party, I purchased unlisted shares. Later, it got listed and sold. Then 111A will come, 112A will not come. Right? Next. At the time of purchase, it was paid, but at the time of sale, it is not done. At the time of purchase, it was paid, but at the time of sale, it was not paid, which means this is reverse. Listed at the time of purchase, then the shares got delisted. Vedanta PLC, for example, Vedanta company was initially listed, then they went for delisting. If that be the case, 112A also will not come, 111A also will not come. Because for 111A to come, they don't care about the purchase, but it has to be done at the sale time. So imagine, for Nykaa, at the time of purchase, it was unlisted, but now it is listed. So which section will come? 111A will come, 20% it will be. Tax will be 20% without any indexation. Ulta case. This is neither 112A nor 111A. This will be normal case. Normal case. Private company shares buying, selling and all, 112A also will not come, 111A will also not come, guys. So they can ask you in anything, twist and turn and ask you questions. You should be very, very careful while answering those areas. Now, whether you pay, let's say you're paying STT, you are investing in shares. If you are doing it as a business, it is PGBP. Otherwise, it is capital gain. Now, my question to you is, you are trading a lot every day. I had a dad's friend. My dad was part of the government service. He was a forest officer. That's how I came to be staying at Mangaluru also. I was, part of that, what do you say, in the forest quarters and all those things, right? So right opposite Pabbas, there is this forest quarters area. You may remember, you may know, right? So there we were living before when I was a small kid. So in the 90s. So what I'm trying to tell here is, yeah, there, why I was telling this, then my dad got, there was a deputation, he was put into some paper mills and all those things. There he had a CFO. CFO, generally during the day, like 11, 12, 1 o'clock and all, you won't have so much work. So that guy was fully into share trading, the CFO of that company. My question to you is very simple. Now he already has a job, plus he is doing share trading. Share trading, you will take it as business or capital gain. That is the biggest thing. If I'm trading in, if I'm a FII, if I'm a foreign institutional investor, I already told you whether it's a capital asset or stock in trade. Government only told it is capital asset, so that there is no confusion, so that you will get tax at a lesser rate. But what about individual like me and you? We are trading in shares left, right, center, listed. So if SSE opts to treat it as stock in trade, if the SSE opts to treat it as stock in trade, he can treat it as stock in trade. Income will be business income. In 2016, Arun Jaitley gave this clarification. Who should decide whether it is capital asset or stock in trade? You should decide. You please declare that, yes, I am a share trader. I am not a broker. I am a trader. I'll do it on my own. You will decide. If you decide, then that is what it is. To dabble in the stock market, you just need a PAN card and an account on Zerodha, for example. That's it. Full day you can play around. Do you need a license from SEBI? No. So at the end of the day, they'll ask you a question. Are you a stock trader? Is this your business or is this just dabbling in it, and is it a capital asset? Who should decide? You should decide. So the SSE should opt to trade as stock in trade, then it will be stock in trade. Otherwise, no. Same. If he has opted for a capital asset, then you should take it as capital asset, no questions asked. Can you keep on changing? One day it is capital asset, one day it is stock in trade? No. That's what they are trying to tell. For listed. For unlisted, there are certain regulations that's not relevant for our exam. We can leave that. So in the exam, please look out for these transactions with respect to 112A, where STT is paid. Sale of equity shares which are listed in a recognized stock exchange, obviously STT is payable. Units of equity oriented mutual fund. Units of equity oriented mutual funds in a recognized stock exchange, obviously it is payable. What is payable? STT. Unlisted shares which is offered to public in an IPO. Yes, it is payable. Shares which are gifted and subsequently listed. Shares are gifted and subsequently they are listed in the stock exchange. Yes, STT is payable. Unit of equity oriented fund which is sold as a mutual fund. Yes, STT is payable. Then for non-resident who is going through a IFSC, International Financial Services Center, India's first IFSC is Gift City, Ahmedabad. Gandhinagar actually. Next to Ahmedabad, there is a twin city, Gandhinagar. RSC, recognized stock exchange, which should be in foreign currency. STT will not be paid. 112A will still come. 112A will still come. These are all the cases where 112A will come with STT. Even though in this case, STT is not applicable also, 112A will come in a non-resident IFSC case. That's a peculiar thing. So 112A will come for listed shares regularly traded. Will it come for unlisted shares? No. For unlisted shares, 50 CA will come. But guys, 50 CA we just discussed. I told you, no, 50 CA, unquoted shares. I should take the FMV as per valuation. But in listed, there is one more type of listed share that is called penny stock. Penny stocks are not regularly traded. When penny stocks are not regularly traded, how will I calculate 112A for that is the question. Equity shares listed, unlisted, no problem. Listed, regularly traded, 112A. Penny stocks not regularly traded, 112A. So penny stocks not regularly traded, how will I figure out the, capital gain for that? That will also deem to be unquoted shares. So when 50 CA comes and 112A both come, this is especially happens for penny stock. Because for a penny stock, it's a equity share. Listed, 112A should come. But ultimately it's unquoted. What is unquoted? Definition of unquoted is unlisted also and penny stock also. What is penny stock? Which is not regularly traded. So penny stocks come under unquoted shares also, which is 50 CA, and come under listed also, which comes under 112A. So what to follow? MCQ question. 50 CA will come or 112A will come. Guys, very, very important. Sale consideration will be as per 50 CA. What is that? FMV. Sale consideration will be FMV. But capital gain calculation will be under 112A. This is an MCQ question they can ask you. Right? So, cost of acquisition 10 lakh. FMV as on 31/1/2018 20 lakh. Actual sale consideration 30 lakh. FMV as per 50 CA 35 lakh. We should take what? FMV. So what is capital gain under 112A? I should take the FMV. 35 minus 20 I should take. Which one? Penny stock. 35 minus 20. 35 minus 20. Basically I should do that, no? Actual sale consideration will I take 30 or 35? 35 I should take, not 30. You see? Sale consideration should be as per 50 CFMV. So what do I do? This or this? I should take this. Now, this or this, whichever is lower, and this or this, whichever is higher, 20. So what will be my cost? 20. What will be my selling price? 35. Not 30. MCQ question. 35 minus 20, 15 lakh. 15 lakh. So in that 15 lakh, what will I do? On the first 1.25 lakh, nil. On the first 1.25 lakh, it will be nil. Remaining 13.5 lakh at 12.5%. At 12.5%. Some more examples for 112. Some more examples for 112. If you are a resident, if you are a, these are all, examination adjustments I'm doing, adjustments. If you are a resident, you're getting LTCG, you're paying at 20% till 22nd July 2024. After that, it is 12.5%. And of course, the basic exemption limit will be 3 lakh. Will you get Chapter 60 deductions? No. Non-resident, again, for non-resident, that basic exemption limit will not be given. Listed shares, if you have gone to the market, STT is paid, 112A will come. Off-market transaction, 10% or 20% was there, but now everything is very simple, 12.5% without indexation. Unlisted shares, for a resident, it is very simple, either two things, 20% or 12.5%. For non-resident, easy entry, easy exit. Was there easy entry, easy exit? There is no more any special provision for non-resident. For a non-resident, now very simple, 12.5% if it is long term without indexation. No questions asked. Absolutely no questions asked. Then if you are a non-resident foreign company, you are buying what? Debentures, bonds, shares, etc. Units you are not buying. Mutual fund you are not buying. Business trust it is not share. So it is mandatory. What option? It's not an option for non-resident. Mandatory to go under first proviso to section 48. TTBR, TTSR, that concept. Mandatory it is. Second proviso talks about indexation. So if first proviso comes, TTBR, TTSR, second proviso will not come. Right? And if 112A comes, wherever 112A comes, second proviso won't come. What is second proviso? Indexation. Anyway, now indexation is removed everywhere. I'm just saying. Whenever first proviso comes, second proviso will not come. And whenever 112A comes, second proviso will not come. So 112A for listed shares or STT is paid. 112A will come. First proviso, TTBR, TTSR will not come. This is for non-resident. Second proviso, indexation will not come. Next. This is very simple now, it's fine. Then special provision all removed now, guys. Listed equity shares sold on recognized stock exchange. Listed equity shares sold on recognized stock exchange. 112A will come. First proviso will not come. Second proviso will not come. And now it is 12.5% without indexation. Very simple. Any off-market transaction in foreign currency. Off-market transaction. First proviso will come because it is off-market transaction, TTBR, TTSR. Second proviso will not come, 112A will not come because it is not going through the market. Anyway, now no questions asked, no nonsense. After 23rd July, it is 12.5%. Nirmala madam actually has made it very easy now. That chart, whatever I've given you, follow. From that chart only some examples I'm throwing at you. That's all, nothing else. Listed company doing an off-market transaction. I mean, you are doing an off-market transaction of a listed share in Indian currency. First proviso will not come because you're doing it in Indian currency. Why will you do TTB, TTSR? Second proviso, indexation would have come, but now indexation is not there from 23rd July. It is 12.5%, no indexation. Unlisted equity shares from 23rd July, 12.5%. Unlisted equity shares sold by promoter IPO. Guys, Paytm promoter, Zomato promoter, Swiggy promoter sold his shares which are unlisted. Sold it in the first ever IPO of no, not first ever IPO. IPO only is the first one. No, in the IPO of Swiggy or Zomato. Very simple. For him, what is it now? Since it is sold after 23rd July, 12.5%, no indexation. Everything is the same only, guys. It's the same only, no tension. Lastly, general rule of taxation was what? In capital gain. Year of taxation is equal to year of transfer. Right? Long-term capital asset indexation is only available till 23rd July 2024. But there are exceptions. What is the exception? Year of taxability will be some other year. We saw this already. 45(1)(a), taxable in the year of receipt of insurance claim. That is destruction of capital asset. 45(2), conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade, it is the year when the stock in trade is actually sold. It is the year in which the capital asset is actually converted to stock in trade. That's fine. But when is it taxable, guys? On the year of conversion, it is not taxable. Whenever the stock in trade is sold eventually, then only it is taxable. 45(5), compulsory acquisition. Compulsory acquisition, whenever the compensation was finally received. We saw interim compensation, final compensation, initial order, final order, all those things. 45(5)(a), joint development agreement, completion certificate either in part or in whole. Indexation. Indexation was there in all these three things. Now anyway, it is not there. Just saying. First proviso to 48, no indexation. Indexation was not there in these things. Bonds, debentures, no indexation. Section 50B, slump sale, no indexation. Goodwill, self-generated asset, no indexation. Bonus share, no indexation. 112A, no indexation. 112 LTCG, all this is gone now. Everything is what? Anyway, no indexation after 23rd July. No indexation. These are some of the areas where FMB is used in Income Tax Act. FMB. 45(1)(a), destruction of asset. If asset is given as a replacement instead of money. 45(2), capital asset converted to stock in trade. FMB is on the rate of conversion or transfer will be the full value of consideration. Stock in trade converted to capital asset. FMB on the date of conversion will be the PGBP and same value will be taken into the block. 45(4), dissolution. 46(2), dividend. 50(ca), sale of unquoted shares. 50(d), when the selling price is not determinable, that is when asset is exchanged, we have seen, FMB will come there. FMB of the asset which I have got, I should take. All shares, bonus, asset before 1/4/2001, FMB benefit of, you should take. Special provision of section 55, bonus shares or bonus shares as on 112A, FMB as on 31st January 2018 has to be taken into account. That's about it, guys. So that's all. With that, we finish what? Capital gains. Very, very easy chapter. Yes or no?